This is a market that's very hard to depress.
Some of the weakness is going to get overlooked in Q4, but the outlook has to be optimistic for this rally to continue.
You have a really good environment, I think, for cross-market positioning.
There'll be winners and losers.
I do anticipate that this quarter we will continue to see some broadening and rotation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, tech stocks bouncing back. TSMC signals renewed confidence in the global AI boom. Oil falling as President Trump is appearing to hold off on attacking Iran. And investors waiting for Morgan Stanley and Goldman Sachs to wrap up big bank earnings on Wall Street.
There are a couple of really important takeaways here. The first one is the bar is so high, given how much some of these shares have sold off in response to otherwise pretty good earnings. It shows how much has already been baked into the price. Just saying that the economy is good isn't good enough. And then there's a question of efficiency, costs. How much can these banks really spend on the tech build out and on their staff without wreaking the wrath of Wall Street? Because people want to see efficiency. That is the word of the day.
We've had a massive move on a bank stocks over the last year, up by something like 30% last year. The year before, up by a similar amount. And to Bramo's point, I've got the numbers in front of me. JP Morgan, one-day performance following earnings, down 4%. Bank of America down almost 4%. Wells Fargo down almost 5%. Citi down more than 3%. That's the problem. Bar super high, mixed results. It's not going to make it happen.
People right now are looking for problems. And right now they see a couple in the banking stocks. And part of this has to do with the political backdrop. The potential for the punch bowl to be taken away, which had been given to them with this idea of deregulation. Well, the question isn't just how much more can you do in M&A. It's what are you going to do about a potential 10% cap on credit card interest rates? And that, I think, is increasingly in the front focus just because the bar is that high.
The message pretty simple in the last 24, 48 hours. Don't do it. That's the message coming from Wall Street. JP Morgan, very bad for the economy. Citi, significant slowdown in the economy if you do this. Wells Fargo, it would have a significant negative impact on credit availability.
The question is, has the message really been taken into account in Washington, D.C.? It's a midterm election year. The president is campaigning on this so much in a way that he's even calling individuals like Senator Elizabeth Warren to see if they can get something through. What I would say is that the 10% cap, first off, if it happens, it's not going to be 10%. It's going to be much higher. But potentially look at the competition bill when it comes to the swipe fees. That has a little bit more legs right now in Washington.
The president also weighing in on the chairman of the Federal Reserve, speaking to our friends over at Reuters. Some select quotes for you. Will you fire him? I don't have any plan to do that. The two Kevins are apparently very good. You have some other people too, but I'll be announcing something over the next couple of weeks. We still wait.
Honestly, this is like the every 2 week rolling, what infrastructure week is going to be next week. I mean, this is sort of what it feels like. At the same time, he was asked also about the pushback from some Republican senators, in particular Tom Tillis, and he said, I would hope that they remain loyal. And loyal to whom? And that was a really interesting note from him.
What I find interesting is the president also said right now we're in a little bit of a holding pattern with him when it comes to Jay Powell. So he understands that right now there is this awkwardness when it comes to potentially if he was going to make his Fed chair announcement. Interesting also, he rolled out Scott Bessent, quote, because he wants to stay where he is. Scott Bessent wants to stay where he is. I still think the president still wants to try to convince the Treasury Secretary to move to the other part of town.
And he's got a few more weeks to do it. It's like a rolling 2 weeks.
Yeah,
A couple more weeks, we'll make an announcement.
You know my real takeaway from that story?
What's
Scott
that?
Bessent was on Air Force One with him and spent some time with him. And this was the result.
You think that was the conversation?
Yeah, don't fire him. Lay off. This isn't good for you, and I'm not going to be a Fed chair.
Well, according to Fox Business as well, we have Rick Reeder going to be in the Oval Office today for his Fed chair interview. So potentially this dark horse candidate could rise to the top, especially if the president hasn't yet made a decision.
Good for Rick. Tracking Rick's career forever.
Oh, yeah.
It's very cool Rick Reeder's got this chance.
Yeah, and you know what? If you become Fed chair, you should come on here and announce it. Right here, this seat, it's waiting for you.
And even if you don't become Fed chair, Rick Reeder, please come on the show and tell us exactly how the interview went.
I get a feeling, I've got a feeling he's not going to do that. Good luck, Rick. Equity futures right now in the S&P 500 positive by about a third of 1%. Coming up this hour, Drew Mattis of MetLife as stocks look to snap a two-day slide. Terry Haynes of Pangea Policy with the US holding off on intervening in Iran. And Pierre Ferragu of New Street Research as TSMC revives AI enthusiasm. We begin this hour with stocks rising on a tech-fueled rebound. Drew Mattis of MetLife seeing headwinds facing the labour market, writing this. Unemployment should be moving higher in the coming months. The K may be starting to crack. as the labour market shows signs of weakness. Drew joins us now for more. Drew, welcome back to the show. Look, here's the issue. The employment market has been weakening for a while now. The story of the last year wasn't great, and it didn't matter to overall markets. Is that about to change?
Well, I think it might, because I think market expectations are for the first half of this year to be driven by tax refunds. And I've got a sneaking suspicion that people's tax refunds in 2026 are going to go pay for Christmas 2025. And so we're not going to get the boost that the market's expecting. And so the hit relative to where the consensus is going to be, I think, significant.
Where would you expect that to show up? We've had a nice run on the equal weight S&P 500. Likewise, the small caps. Is it an equity story or something else?
I think it's, first of all, it's an economic data story. So we're going to get economic data. I think it's going to look like the consumer is rolling over. I think any sort of move like that then leads to pullbacks in the labor market. And I think if you look at things like the Federal Reserve consumer surveys, what they're showing is that job separation anxiety is really not focused in kind of the lower income tiers of society, but the upper income tiers of society. And so it really means that for this to play out, it's got to play out through the labor market channel, and it's got to move from being a no hire, no fire story to people actually worrying about layoffs.
Drew, in the time when information seems somewhat muddy and we get economic data, a lot of people raise questions about it. People are increasingly looking to earnings for some clues. Earnings so far have been really good. The bar is high, yes, but the earnings, particularly for the broader market, seems to be delivering. What are we not getting right by looking at the earnings that you see in the overlying economy?
Well, I know this sounds crazy, but trying to predict the macro with micro has failed every time. Right? You just can't do it. I haven't seen anyone be able to do it. You would think you should be able to do it. And particularly now with more data and better technology that we should be able to do it, but it's just not the way that it works. Bearing in mind that what you're trying to predict is actually not necessarily the truth. You're trying to predict the government's version of what happened based on surveys, right? So you're trying to predict the survey using some survey of your own. So adds kind of levels of complication. I think that I think the market's very optimistic about AI. I think it's incredibly optimistic about productivity. I think it's warranted, but I think the timing's off. So I think short term, these are all technologies that A, cost a lot of money, and B, we have to figure out how to use. And I don't think we've quite done that yet. And if the response to figuring out how to use it is to not hire junior people, that's a mistake, because the junior people that I'm seeing coming out of college know a lot more about AI than anyone I'm currently working with, right? And they use it, and they've used it since high school. And if you get someone who's used something their entire life, they use it differently than people who had to learn to use it like in the point in their career that I'm at. And so I think that, it could just be that, firms are going to, hey, we're cutting back on hiring because of AI. This is great. And they wake up 3 years later and realize that they actually cut back on hiring in the exact wrong demographic that they should have cut back on.
Drew, you have this feeling that even if you do get unemployment rising, you put it through the market channel and you still get 10-year yields that are going to be above 4%. How does that square? I mean, if you really do think that the K is cracking to the downside and you are going to get a rise in unemployment, why wouldn't that lead to significantly lower yields?
So I'm gonna give away my rule of thumb for yields. It's nominal GDP. It's usually a pretty good measure. It usually works pretty well. We've got above average inflation, and we've got real growth that's a little tepid, and you net it out and it's a little above 4. And it's likely to be a little above 4. And then think about the boundaries of yields. If yields go up too far, the Fed will respond to that, and you'll get a cut, and then it'll really depend on an inflation story. Whereas if yields disappoint, or the Fed stays too high for too long, then yields could fall. And of course, that would prompt a response from the Fed, because you're going to have a weakening economy causing those yields to fall, and they'll respond by rate cuts. So I think that there's a bound that we're operating in now. And it's pretty easy, I think, to see the range of that bound. Not the exact range, but you can see that there's an upper limit and a lower limit. Because we have a pretty good sense of where the economy is heading. We just don't know necessarily why it's going there, and kind of what the composition is. But in my view of the universe, the composition doesn't matter. It's the combo of inflation plus real GDP.
Drew, we've had a plethora of ideas being thrown out, populist ideas really, from this administration, given this is a midterm election year. Do you think if some of these get through Congress, we actually see them materialize, that could goose inflation?
Well, I mean, I think, if you think about affordability, one of the main items on everyone's list really is paying your taxes. So, I mean, I think, in terms of affordability, it should get better as kind of the tax law kind of progresses and people see that. If I'm right about them using it for last year, it might disappoint people, but at the same point, it allowed them to pay for last year. Some of the others are. I'm kind of the opinion that you should do as little as possible, all right, in terms of government. And when you're doing as little as possible, you cost as little as possible. And therefore, everyone can kind of focus on productivity enhancing goods, how you create new businesses and how you create new jobs, which is the whole point of people kind of becoming entrepreneurs and starting businesses is to kind of solve problems for people. And so the more you're out of their way, the more problems are being solved.
I thought of you yesterday when Torsten Slok put out his 10 tailwinds in 2026 because number 6 was the World Cup. Do you think that's a real catalyst for growth this year in the United States?
It's probably a catalyst for growth in the way that kind of anything like that is. Is it going to be a catalyst for soccer in the United States? That one I'm a little more skeptical on.
Drew, what a missed opportunity for that sport in this country, don't you think? Just being squandered at the moment by charging such high ticket prices.
Well, if you want to expand interest in the sport, people have to be able to see it and they have to be able to take their kids to it and not have to take out a second mortgage for it. So I think it's going to be one of those situations where people post it on Instagram, they're not watching the game, and they're the ones standing up in front of me while I'm trying to watch the game in the stadium. They're the ones standing up to get T-shirts, drinks, food. This is not the NFL.
Ridiculous.
There's not 4 minutes between plays. So you need to actually sit down and watch the game if you're going to be in attendance at the World Cup.
You tell him, Drew. Drew, thank you, sir. Drew Manis of MetLife. Drew, thank you very much. What a perfect opportunity. I think the perfect time to host the World Cup in this country. Back in '94, way too early. 2026, game's really taken off. You see young people playing the game in a much, much bigger way over the last couple of decades. And what do? FIFA comes along and charges an absolute fortune for people to go and watch.
Maybe President Trump is listening and he's going to cap the fees that people can pay for these tickets. Look, you're right about this. This is sort of the flip side in the United States, given how much wealth there is. And this is exactly the wealth effect. Not to get to the K-shaped economy, but the fact that people can pay those ticket prices is the reason why they are so expensive. There are enough people who are willing to pay those in corporations. And this is part of the issue. How do people who just want to take their kids to the game?
There's another problem, too, with the State Department putting a processing visa freeze on 75 countries, including countries like Brazil, which we know have avid soccer fans, diehard fans. There's a carve out for the World Cup, but it could temper some of that demand of, the hardcore fans coming to the United States and so excited for the World Cup.
It's why the atmosphere at Arthur Ashe is so bad for the US Open, that you end up getting a bunch of rich guys coming over from Manhattan who are sipping on $20 drinks and not even watching the sport. Is that what we want the World Cup to be this year?
Watch the warm-ups. That's my key to you, because those are actually really fun. I hear you, so I try to find the loopholes, right? And the loopholes are you watch people practicing. And
You let us know the loophole. I mean, that sounds kind of sad. But anyway, all right. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, good morning. President Donald Trump insisting he does not plan to fire Fed Chair Jerome Powell. The president telling Reuters he has not arrived at a conclusion about whether the Justice Department probe of the Fed would give him grounds to oust the chair. President Trump also signaling he may hold off on attacking Iran for now. Trump making the comments after getting assurances that the government in Tehran would stop killing protesters, he says. Trump says he was given that information from what he called very important sources. BlackRock pulling in $342 billion of total client cash in the fourth quarter, pushing the firm to a record $14 trillion of assets. Investors adding $268 billion on a net basis to its long-term investment funds. BlackRock's adjusted earnings per share also rose 10% from a year ago to $13.16, beating estimates. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. More from the big banks a little bit later. Over the next hour or so, we'll hear from Morgan Stanley and from Goldman Sachs. Need to check out crude this morning. Up next, turning down the temperature with Iran.
We've been told that the killing in Iran is stopping, and it's stopped, and it's stopping. We're going to watch it and see what the process is, but we were given a very good statement by people that are aware of what's going on.
Crude down by more than 3% on WTI and on Brent. Up next, we'll catch up with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning. Tech stocks bouncing back this morning. The Nasdaq 100 higher by 0.8%. Decent numbers, strong outlook coming out of Taiwan Semi, earmarking up to $56 billion in capital spending for 2026. The broader tech ecosystem seems to like it. The Nasdaq higher by 0.8%. Turning to crude, check out Brent and WTI trading lower this morning. Crude down by more than 3%. Under surveillance this morning, turning down the temperature with Iran.
We've been told that the killing in Iran is stopping, and it's stopped, and it's stopping. And there's no plan for executions or executions. I'm sure if it happens, we'll all be very upset. We're going to watch it and see what the process is, but we were given a very good statement by people that are aware of what's going on.
So here's the latest this morning. The president shifting his tone on Iran. He signaled he'll hold off on attacking the country, at least for now. Joining us now from Washington is Bloomberg's Tyler Kendall. Good morning, Tyler. What is the latest on this front?
Yeah, hey, John, good morning. Well, this does mark a shift in tone from President Trump. The potential for military strikes still remains on the table, though his comments that you just heard, combined with a top Iranian official pledging not to carry out executions, has appeared to narrow the potential that a U.S. attack is imminent just one day after President Trump urged Iranians to continue protesting and said that help was on the way. Our own analysts at Bloomberg Economics say that this could be strategic ambiguity, and at this point, it's just too early to rule anything out. Now, there's a few different signs that we're watching, including that the U.S. decided to redeploy American military personnel from Qatar and other U.S. bases in the region amid escalating tensions. And a U.S. official has confirmed that President Trump has been briefed every day this week on a potential range of options, from airstrikes to cyber attacks to diplomacy, though the president did post earlier on Truth Social that he was canceling any meetings with Iranians before we heard these comments. Now, the White House's threats have really been heightened over the past week amid the U.S. operation in Venezuela that captured Nicolas Maduro, but also the fact that we have seen the death toll in Iran surge. John, according to statistics cited by Bloomberg News from the Iran's human rights group, the death toll has now surpassed 3,400 people in what is considered to be the deadliest crackdown in the country in decades.
Tragic. Tyler, thanks for the update. Appreciate it. Joining us now to discuss is Terry Haynes of Pan-Geopolicy. Terry, it goes without saying that Iran is not Venezuela. The population is 3 times the size. I think the population of Tehran is equal to New York City. It has very, very complicated power structures. How difficult is it going to be if the president chooses to intervene?
It's going to be very difficult, John, and good morning. But I think what you have to look at here is a very different geopolitical situation in Iran than in Venezuela. What I mean by that is kind of what I think of as the concert of nations in the Middle East, most of which want not only want a more peaceful region, but they want Iran marginalized, but they want that done without dramatically escalating tensions in the region. That's a difficult lock to pick, but the president needs to bring those folks along, just as he has in the Israeli-Gaza matter over the past few years, and just contrast that with the Venezuelan situation, which is very different.
Terry, will he have the support of Congress if he were to intervene in Iran?
That's a very good question, and it's a better question after the Venezuelan vote earlier this week. All White Houses do things well or badly at any given time. One of the things that this White House is doing badly right now is bringing Congress along with it on a lot of different fronts. And the warning shot on Venezuela really is I think a confirmation of my view there. They need to do a lot more spade work with Iran and geopolitically overall. Before they make a move here to try to either have the active support of Congress or to neutralize opposition.
This is just the second week into 2026. We've already seen the president take action in Venezuela. How does he convey these moves to the American public in a midterm election year? How does he go out and say this is part of, quote, America first?
Well, he should, and the easiest messaging there is something along the lines of, we're keeping national security is economic security. We're trying to keep America safe abroad in order to make America safer at home, that sort of thing. And but beyond that, he needs to get much more contextual with the American public and start really explaining the stakes of a lot of things a lot more. He's got a lot of division in his coalition right now. I wouldn't say a lot of them are actively opposing him, but there's a lot of people who have colder feet than they did a few months ago. He's going to need to warm that up. Same, of course, exists with domestic policy, but he's really going to need to start having people understand what the stakes are. Part of his base gets that, part of it doesn't.
Terry, what the stakes are includes who the friends are and who the enemies are. Do you think that it's clear which international allies have the loudest voice when it comes to talking with the president right now?
Do I think it's clear? No. I think there's an awful lot of folks who are jockeying for attention, and to some extent that's the way the president likes it. I mean, if you've got people swirling around you, kind of spoke and wheel style, it increases your freedom of maneuver, and that fundamentally is what Trump wants. He doesn't want just the ability to act. The ability to act implies the freedom to maneuver. So a lot of his strategic ambiguity, as Tyler put it, is designed to achieve exactly that. So the more he's got competition for his ear, and the more he's got competition for potential geopolitical goals, I think frankly the better he likes it. That makes it more difficult to translate into clarity for the American public, but that's a chance he's willing to take right now, judging by how he operates.
Terry, something we've been talking about over the past couple of weeks, and I'd love your thoughts on that. How do you understand sort of the flurry of different orders coming out of the White House, the different focuses, whether it's geopolitical or whether it's domestic, that seem to be whipsawing markets and whipsawing Capitol Hill?
Well, I think what markets see is a lot of different smoke being thrown up for a lot of different reasons. I mean, there's the strategic ambiguity on Iran we've already talked about, for example. Same thing applies on a lot of domestic things. The credit card matter is a perfect example of this. I feel like I've been talking about swipe fees literally forever. I think the first time it came up was 20 years ago. But a lot of that's being put up, frankly, as part of the affordability pitch to appeal to his independent base, the one that helped him get elected in 2024. I'm not poo-pooing this by saying it's just about politics. Trump has a history of following through, but people need to understand that he's going to do everything he can to goose his own coalition to keep Republicans in the majority in the House and the Senate next year. Part of that is making sure that he's flooding the zone and kind of even stealing ideas from the other side and kind of relegating that to niche stuff, whereas everything else ought to be about him and ought to be about goosing his vote. I hope that helps.
Terry Haynes, helpful, sir, as always. Thank you. Terry Haynes of Pangea Policy. Lisa, to your point, whipsawing equity market, not so much the bond market. This incredibly tight range in the 10-year continues. The low intraday all year, 412. The high, 420. Operating in an 8 basis point range for the year so far.
There are two ways of looking at this. Actually, there are three ways of looking at this. The first way is that the balanced risks are so balanced, they're whipsawing each other at the same time to create a balance. The second thing is that actually, regardless, the economy is sort of chugging along in this disinflationary productive boom, which is exactly right. And then the third is completely complacent and not paying attention at all. Which is it?
Torsten Slok of Apollo pointing out yesterday, you mentioned his note. This is going to be a hot economy this year. We'll debate that in just a moment. Up next, we'll catch up with Pierre Ferragu of New Street Research as TSMC drives a rebound in big tech. Plus, Vonnie has your morning movers. Shares of Spotify rising this morning on higher subscription prices. That name up by 2.5%. Back-to-back losses on the S&P 500 for the first time so far this year, pulling back from all-time highs. This morning, a bounce on the S&P 500 by 1/3%. Worth pointing out, though, as many of you have already, it's not really about the market cap-weighted S&P 500 so far this year. The equal weight on a 5-day winning run. The Russell so far this year higher by almost 7%. midway through January.
9 consecutive days of outperformance by the Russell 2000 versus the S&P 500. That is the longest streak going back to 2017. And the last time it was more than 9 days, you have to go back to 2008. What's interesting about this, it's not coming with interest rate cuts that are expected in the market. You've seen actually 2-year yields rise during that time. So there's something else going on here.
A better outlook for growth, the Torsten Slok view of the world for 2026 maybe?
Exactly. What's it telling us? I mean, that's sort of the question. Is good news good news? Thank you, Stuart Kaiser.
Yields up on the front end of the curve by just a single basis point. Equity futures looking at the Russell up by around about a third so far this morning. As we count you down to the opening bell, let's get you some morning movers, some single names. Let's cross over to Vonnie for more. Hey, Vonnie.
Hey, John, well, we're back in the embrace of the AI trade. It sort of feels like home, doesn't it? Once again, TSMC coming out with a forecast saying that sales will be up by 30% in dollar terms and CapEx spending will be $56 billion. Now, both of those numbers surprised analysts and investors, and as you can see, it's being reflected in the stock. Now, interestingly, Applied Materials, which is obviously a big supplier of TSMC, is having the halo effect. It already hit a record in Amsterdam trading today, but Applied Materials is now the Nvidia, really, of the European stock market. It's only the third company ever to reach $500 billion in market cap, which it has now done, behind LVMH and Novo Nordisk. And now, as goes Applied Materials, so goes the European market. All right, let's move on because Soho House is another stock on the move today, up more than 12%. You remember it tried to IPO a couple of times. Things didn't work out. Then it announced that deal for a take private operation back in August. Now it has secured funding for that deal, up to $200 million worth. It would value the enterprise at $2.6, $2.7 billion, including debt, and that group is led by MCR Hospitality. And then Spotify is also higher today, up 3%. This stock has lagged the broader market. It's only up about 8%, which I know it's not terrible, right? But 8% over the last 12 months. It's going to increase subscription pricing just by $1 from next month. You're talking $12.99 instead of $11.99 a month. It's been battling YouTube and apparently algorithm fatigue, which I think is something we might start to hear a lot more about.
There we go. Vonnie, thank you. Thanks for the update. Spotify this morning up by 3%. On our radar this morning, Iran reopening its airspace after temporarily halting most incoming and outgoing flights. The closure coming as tensions continue to grow with the US and nationwide protests throughout the country. Elsewhere, Greenland and Denmark saying, quote, a fundamental disagreement remains after meeting with top US officials. Germany taking the lead among European nations, sending military personnel as it tries to help the island avoid a US takeover. And finally, the White House holding off on a new tariffs targeting import of critical minerals. President Donald Trump instead seeking to negotiate agreements with foreign nations, warning import restrictions remain on the table.
So he's keeping the option open. This has to go back to an investigation that was started by the Commerce Department in April under Section 232. They're concerned about national security concerns, but at the same time, we need these minerals for our defense sector. The biggest issue they have is if there was going to be a flood of really cheap levels into the United States that would hurt the small industry that the United States have, and then potentially I think the president would look at potentially putting on those duties. But for now, he wants to go back to the negotiating table.
Well, if I were a silver trader and I was looking at this, I'd say, because ultimately, how much is this part of what we have seen with this rip-roaring rally that we've seen in silver, not to mention gold and tin and aluminum and all the others in copper, because the idea was you got to stockpile this stuff to get ahead of any potential tariff. Well, if you don't have to stockpile it, what does that do? Well, it looks like any kind of sell-off in silver has faded. So a real question here about how significantly this was behind some of the rise in prices. Nonetheless, interesting to watch.
Not the only pillar driving the silver trade, of course. Silver up by, 150% just
At
last
least.
year?
Yeah, it's insane.
This morning we're down about 2%. Small fry, 91.29. Let's turn back to tech. TSMC's blockbuster earnings driving a major rebound across chip stocks. The chip giant projecting as much as $56 billion in capex for 2026. Bloomberg's Peter Alstrom joins us now for more. Peter, looking at the size of those numbers, do you see any sign that this story's slowing down?
Well, it was a very interesting report from TSMC, of course, closely watched because they make chips for NVIDIA and many others in the industry, including Apple and Qualcomm. And the conference call after the results was very interesting. As mentioned earlier, revenue is expected to go up close to 30% this year. They're boosting their capex from $40.9 billion last year to this range of up to $56 billion. So it's a very sizable increase, more than 35%. So it does not look like it's slowing down at all. But the CEO, C.C. Wei, had some very interesting comments to say afterwards. He got some questions about, is AI demand really going to meet the expectations here? And he said it's not clear whether AI demand is real or not. He said he's very nervous about that. He said they're talking about investing up to this $56 billion. He said if we don't do it carefully, that'd be a big disaster for TSMC. So there is a note of caution, even though, of course, this is driving stock prices, not just at TSMC, but also ASML here in Europe and Applied Materials in the US, as alluded to earlier.
Peter, help a man out. How do you invest $56 billion carefully? How does that work in practice?
Well, TSMC, of course, is expanding a lot in the United States. So we have this trade deal between the U.S. and Taiwan that's under discussions right now. TSMC has been investing in fabs in the U.S. They want to make more of their chips in the U.S. That's certainly good for the U.S. economy. They have been very clear, though, they want to keep the most cutting-edge chips in Taiwan. For a long time, they only made chips in Taiwan because it's easier to control quality. The manufacturing process for chips is so difficult, so complicated that it helps to have all the engineers very near each other. It's also worth talking just for a moment about their margins, though. Their margins now, they're looking at them going up to 63 to 65%. This is actually higher than what they want. You don't hear companies talk about this very much, but their long-term target has been to keep that around 55%. Part of the reason is they are the company to go to for the most advanced chips that are out there. They don't want their customers to go someplace else. They want to keep margins low. They want to offer some affordable prices, so they keep getting all that business from NVIDIA, Apple, and all the other important customers that they have.
Peter, appreciate your time. Thanks for the input this morning. Thank you, sir. Bloomberg's Peter Astrom there with the latest. To extend the conversation, Pierre Ferragou of New Street Research joins us now for more. Pierre, look at those numbers from TSMC. Is that the good news this ecosystem needed?
Yeah, it's fascinating news. We really highlighted TSMC as a primary name to look at this year for the AI trade, and they actually beat our expectations on what they said. What's really interesting in what they say is actually they are the only ones to really give like a 5-year outlook to 2029 with some good granularity, and that's really the numbers you want to look at. So what TSMC said implies that this year, what they're going to sell to their AI customer is going to more than double in 2026. And after that, it's still going to grow 30% a year to 2029. So we are still in a setup where growth is very, very strong, continues to be revised up, and we have already fairly strong industry visibility on the duration of this growth towards the end of the decade. That's fairly impressive.
Pierre, John was asking this question, how do you invest $56 billion carefully? And I kind of think of tech CEOs as therapists trying to reflect the mood of markets at any given time. And right now, people are looking for caution because they're looking to poke holes in this narrative. What about what TSMC said actually relieved them, gave them a sense that this would be done with enough caution that wouldn't leave them high and dry?
Yeah, it's an excellent question. If there is one organization in this world that can invest $56 billion with caution, it's TSMC. For a very simple reason. They're going to invest this money in fabs that nobody else can deploy. And the risk they take is actually relatively narrow. They only risk to spend that money too fast. So let's say they spend $56 billion this year, and everybody revised down their needs for AI chip at the end of this year. They would be, 6 months ahead of timing, a year ahead of timing, of normal timing in terms of how much capacity they need to add to their fabs. So the risk for TSMC is actually very limited. Now, if you're a memory manufacturer, if you're another player, there is a risk of overcapacity on your side and the side of your competitors that creates far more complex competitive dynamics. But when you are the only game in town, actually the risk is much more limited.
How much, Pierre, do you expect them to accelerate their investment in the United States right now, given the concern about China and Taiwan and any potential conflagration militarily there?
Well, when you go to Phoenix and see already TSMC employing maybe now close to 20,000 people and all the fabs building up, they are actually pedal to metal in terms of the pace of investment in the US. I think it would be difficult for them to go faster than the plans they have today. And we're talking, towards the end of the decade, having in excess of 100,000 wafer starts manufactured in the US at the leading edge. What you could expect is that it's only going to be the beginning, and the footprint of TSMC in the US is going to continue to expand. Now, in order to do that, you're talking about tens of thousands of jobs of highly skilled employees. So it actually takes a lot of time to create the pipelines, the university pipelines, the job market pipeline to do that. And it's so I wouldn't expect them to go faster because they're already going very, very fast.
Peter brought up a point that this is being discussed right now, part of the Taiwan trade pact with the United States. And TSMC would have to pledge to build at least 4 more chip manufacturing plants. Pierre, how long would that take?
The first wave took easily 6-7 years, and now things are going to go maybe twice faster, so maybe 3-4 years before you start seeing these fabs ramping up, and then another 3-4 years for the fab to fully ramp. So an additional 4 fabs fully utilized, maybe 6-7 years. It takes time.
Pierre, before you go, I want to squeeze in a final question. The number one conversation I'm having at the moment offline is something not many people are willing to talk about online. In fact, I had a conversation with an equity strategist just last week, and once the conversation finished, they stood there just to my left, I'm not going to say who it was, and they said the number one question I've had from clients is what happens if OpenAI goes bust? If they go under, what happens? Pierre, are you getting the same question, and what are you telling people?
Yes, I get the same question. My first, that's one of the 2 main questions I get. And my answer to that is simply, well, if OpenAI goes under, that's because of competition from Microsoft and Amazon, like Anthropic and Amazon, and most importantly, Google. That doesn't mean the AI opportunity is not there. And today, OpenAI and Anthropic combined represents $30 billion of recurring revenue. So it's like the highest quality revenue you can imagine. And that revenue grew 4x in the last 12 months. So OpenAI is sitting on the most incredible opportunity we've ever seen. And they're only a startup, so they could go bust because they have very, very tough competition. And the comeback of Google in that space in the last 6 months is probably a source of concern for OpenAI, and I think they agree with that. So they could get into trouble, but that wouldn't mean the AI race and the need for more silicon, especially for TSMC, would go with it.
Pierre, thank you, sir. Appreciate the on-the-record comment. Thank you. Pierre Ferro there of New Street Research. Interesting when you ask them, what's the number one question you're getting from clients? It's like top 2. Maybe number 1.
Well, because it is inflated, and I'm talking about OpenAI, has inflated some of the valuations of data centers in particular, which affect a pretty broad ecosystem of financial firms in terms of who's invested in that. So not only, yes, there is the demand, but is there going to be building a bridge to nowhere, essentially? Is there going to be Meta, for example, buying data centers that they don't even need to use just so that you don't get OpenAI buying them? That is really the key question.
A better story this morning, at least for the tech sector. The Nasdaq is higher by 0.8%. With an update on stories worldwide. With your Bloomberg brief, let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump saying Ukraine leader Volodymyr Zelensky is the main obstacle to an agreement to end its war with Russia. The president telling Reuters Vladimir Putin is, quote, ready to make a deal. Another shooting in Minneapolis. A federal officer shot a man in the leg last night. A spokeswoman for the Department of Homeland Security says the shooting followed a targeted traffic stop. The man who was trying to flee in his vehicle crashed into a parked car and then took off on foot. He was reportedly shot while trying to evade arrest. And Verizon restoring service on its wireless network after a widespread outage yesterday. Down Detector logging more than 1.5 million reports over the course of the approximately 10-hour outage. Verizon saying it'll provide account credits to affected customers and apologising for the disruption, but not giving any explanation for what caused its network to go down. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. Thank you very much. Up next on the programme, consumers still spending.
You're seeing that consumers are out there still spending. So I think the underlying pace of income growth has been a bit of a challenge with just the jobs market slowing.
Up next, we'll catch up with Greg Dacko of EY Parthenon from New York City. You're watching Bloomberg TV. Live from New York City, welcome to the program. A little bit later this morning, in the next hour, you'll have results from Morgan Stanley and Goldman Sachs. Look out for that. Into that, your scores look like this. Equity futures on the S&P 500 positive by 1/3%. The Nasdaq bouncing back this morning, higher by 0.8%. Better numbers out of TSMC, lifting the tech sector. The one to watch for the year so far has been the Russell, up by almost 7% for 2026, up this morning by 1/10%. Pulled back from record highs on a market cap S&P 500, just seeing the equal weight outperform, the small caps outperform. Is it another head fake, or is this the story for the year ahead?
We started last year. The rotation was it. This was the year when big tech was going to fall behind and everything else would be the adoption trade. Let's go. People are saying the same thing this year, and we are seeing it in the performance. Is this time different, and does it really rely on tech adoption or maybe something else?
Well, let's talk about the something else, the economy. Under surveillance this morning, consumers still spending.
You're seeing that consumers are out there still spending. So I think the underlying pace of income growth has been a bit of a challenge with just the jobs market slowing. At the end of the day, consumers still have their jobs, even if you are seeing a more sluggish jobs market. So we're seeing that filter through in spending. And while I think you're seeing some underlying inflationary pressures begin to dissipate, it's only happening gradually.
So here's the latest this morning. Retail sales rebounding by the most since July, signaling continued consumer resilience. Greg Decker of EY Parthenon writing, consumer strength is largely supported by higher income households, but that won't last forever. Greg joins us now for more. Greg, good morning.
Good morning.
Any signs it's fading?
I think what we are seeing, and this continues to be the case, is this increasing bifurcation, but it's not as simple as people make it sound. What you have is essentially the have-nots, the have and the have-a-lots. And that bifurcation is much broader than just a simple K-shaped type of environment. And I think that matters a great deal because what we're seeing in terms of labor market developments, in terms of income developments, is key in driving the outlook in 2026. We are going to see two realities at the same time. Average growth for consumer spending and for the economy is still going to be relatively healthy, around 2.5%. But there is going to be an increasing number of individuals that face these headwinds from reduced income growth, from a still high interest rate environment, and from an environment where prices and costs remain elevated. That is going to constrain a large share of the population, those that are at the lower end of the income spectrum and median end of the income spectrum. But the people that are above that are still going to be able to trend relatively well in this environment.
So let's park the have-a-lots.
Yeah.
Are you suggesting that the have-nots, that stress is going to migrate up income groups to the haves?
It has been. It has been. If you look at the trends in terms of income growth, you can see that income growth for the lower income tranches of the population is under pressure. It is fading more rapidly. And so while average wage growth is still around 3.5%, which is what it usually is in normal times, you are seeing this downward pressure for lower income groups. And that downward pressure in terms of wage growth is indicative of a labor market where labor demand is fading faster than labor supply. It's not alarming yet because we've had a massive negative shock in terms of labor supply, so that the break-even rate is very close to zero. But the fact that over the past 3 months we've seen negative job growth is a telltale sign that income growth for the rest of the year is going to be under downward pressure.
Are rate cuts the best way to deal with this?
Not necessarily. Rate cuts are helpful in the sense that they help on the margin ease some of the credit stress. But the reality is that we are not seeing necessarily that credit stress be the key hamper in terms of economic activity. If you look at what's driving economic activity right now, it's the 3 A's that I've mentioned before, the 3 narrow pillars of growth: affluent consumers, AI investment, and asset price appreciation, stock market gains, which we've been talking about for the morning. Those 3 pillars are still very much present, and they're not as influenced, as sensitive to interest rates as we might believe.
At the same time, financial markets are very sensitive to interest rate cuts.
Yes.
And this is a fear out there, I share it, but let's just put it out there as generic, that if the Fed does cut rates, it inflates the valuations of a lot of asset prices, which feeds the wealth effect, which feeds inflation, because the higher end consumer is the one that's spending and the one that's benefiting from some of these gains, which only makes that K-shaped or whatever shape you're talking about that much wider. Why isn't that a more likely path of travel if the Fed were to cut rates aggressively right now?
I think that's potentially a real risk in terms of inflation dynamics, because we often tend to think of technological revolutions as being a productivity enhancing revolution that eases inflationary pressures. But the first thing that we have to keep in mind is that for any technological revolution, you need capital investment. And capital investment tends to be inflationary. It puts pressure on resources and tends to lead to higher inflation. So in the short run, you can actually have inflationary pressures on the sectors that are most intensively using that technology or putting a lot of efforts in driving that technology, establishing that technology. And that is where you can get some sources of inflation. But if you look at the underlying trends in the US right now, you're not seeing much inflationary pressures. There are two conflicting cross-currents. One, tariff-induced inflationary pressures on the goods front, but highly uneven. Goods price inflation around 1.4% right now. It's not excessively concerning. It's up from a deflationary environment in normal times. But at the same time, you have disinflation coming from the housing and shelter side of the picture, which is very strong and was key to the driving up inflation in 2021 and 2022. Now it's a key factor driving inflation lower. So I'm not excessively concerned about inflation right now. We're probably going to be trending back towards 2.5% by the end of the year. It's not excessively alarming. I think most Fed policymakers will be on that page, which is essentially considering what economic data is doing because the policy rate is very close to that neutral range, and there isn't really a need for immediate movements in interest rates.
Are there risks, though, in Washington with policies that could be risky for inflation moving to the upside?
Yeah, I mean, there are significant risks in terms of, one, the tariff outlook, two, the immigration outlook, which I think is under-discussed, but in an environment where we're seeing massive negative pressure on labor supply from aging demographic, from potentially a shrinking population by 2030, we are going to be in this environment where the scarcity of resources can put upward pressure on inflation, not in the short run, but really in the long run. That's really where I'm most concerned, is that there is a risk that we see persistently higher inflation, not around 2%, but around 2.5%, which could become a binding constraint for the Fed because the mandate is essentially 2% inflation. Whether I am concerned about 2.5% inflation is a different question. I think there should be a band of tolerance around 2% that allows for policymakers to have more latitude in adjusting monetary policy and not be focused on this pinpoint estimate of 2%.
Aren't they operating as if they have one already?
Yeah, that's exactly what I was thinking.
They might, but they would never say that unless there is a change in the framework. And you know how difficult changing the framework can be and how politically sensitive it can be in the current environment. So I would argue that this type of band around 2%, maybe 50 basis points around 2%, would make a lot more sense. It would have made a lot more sense before the pandemic. Remember, we were arguing about a couple of tenths to get up to 2%, and there was this question around, does the policy need to be tightened when inflation is approaching 2%? I think that band of tolerance would help a great deal.
Greg Deco of EY. Greg, thank you, sir.
Thank you.
Some might argue that band's maybe a little wider.
Oh, it's already existed. We have a 100 basis point band, and basically we've been experiencing that since 2020. And this is the reason why people say that they've already adopted this. It's just, don't worry, it'll get there.
We'll just carry on as if nothing changed.
Correct.
Yeah, sure. Equity futures right now in the S&P 500 up by 1/3% in the next hour on Bloomberg Surveillance. Kevin Gordon of Charles Schwab, Jason Furman of the Harvard Kennedy School, Gerard Cassidy of RBC Capital Markets, Jason Thomas of Carlyle. Numbers, earnings, results from Morgan Stanley and Goldman Sachs in the next hour of Bloomberg Surveillance.
This is a growth story.
We've seen really resilient growth.
You have inflation coming down, growth resilient.
We're still in a K-shaped recovery.
You're seeing some underlying inflationary pressures begin to dissipate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 positive by around about 1/3%. The outperformance on the Nasdaq this morning. Thank you, Taiwan Semi. The Nasdaq up by 0.8%. For the hour ahead, it's all about two names. Earnings from Morgan Stanley and Goldman Sachs. So far, not great for the financials on the Wall Street. The numbers are decent, but the stock reaction not great at all. And we've seen that from bank after bank after bank over the last 2 days.
And it seems like investors have been really looking for reasons to not be impressed. And it seems like each one is a different reason, whether it's the costs are too high, whether it's that investment banking revenues missed and the deals were pushed to 2026, as we saw in JP Morgan's case. When it comes to Morgan Stanley and Goldman Sachs, they are investment banks at their core. So the key question will be less about the 10% cap on credit cards, and less about some of these more consumer-facing businesses, and much more about what they do with respect to M&A, with respect to the deals, with respect to issuance, and going forward, what the economy really looks like.
That was a little bit of a weak spot for some of the names, that maybe the boom in M&A that we thought we'd see, we didn't get. They're trying to flag that it's going to come in 26, and I wonder if we see the same thing from Goldman and Morgan Stanley later this morning.
And if we don't, do people call on some of the other banks that have talked about push deals? In other words, is competition getting incredibly steep for some of these banks? It's going to be an interesting check on that narrative.
Morgan Stanley up by 0.7%. If you can't ask them about credit cards, ask them about central bank independence. That question's come up a few times this week as well. The president's weighed in, speaking to our friends over at Reuters. Will you sack him? The chairman, Jay Powell, I don't have any plan to do that. What about a new announcement to replace him? You'll hear something over the next couple of weeks.
Another 2 weeks, another 2 weeks, another 2 weeks. When he hasn't had a firm decision, he usually just punts it. The Treasury Secretary said we would get an announcement for before or after Davos. So basically January. So he has 2 more weeks actually to this point to make that announcement. We do have Rick Reeder going in for an interview today, according to Fox Business. And then after Rick comes out of that interview, he is done. All the Fed candidates will have their interview, and it's up to the president to make his decision. He says the 2 Kevins are very good, but the guy he wants doesn't want the job because he wants to stay where he is, said the president, and that's Scott Bessent.
Do you think that Jamie Dimon is the last one to really talk about Fed independence and the rest of the bank CEOs will be like,
no thanks?
Yeah. Do you think that that's going to happen? I mean, if they get asked about this, do you be like, I think that enough's been said about this and our views are clear. Thank you. Next.
I think the JP Morgan C-suite is quite unique, and the CEO there seems to speak his mind in a way that other central bankers, or rather other bankers, don't. I'll say this about the race. I don't really understand what's gone on here. It kind of made sense at the beginning that we'd have this shadow Fed chair get announced early. That individual would be super dovish and would compromise the outlook that Chairman Powell was trying to deliver. I understood the strategy there. I don't understand the strategy here. It seems to have galvanized other members of the committee to push back, get people to dig in, to see the chairman on a Sunday basically push back so publicly. I don't think any of that's good to get lower interest rates. And if you want lower interest rates, this ain't working.
Well, if you were a TV producer and you wanted to make the Fed interesting, well, congratulations.
You've done that. Great.
You've made the Fed interesting again. I do think there also is this potential scapegoat hanging in the wings, so that at any point, if you worry about affordability, you can say, hey, guess what? This guy, he's not good. And I think that it's nice to have that scapegoat around.
Also, if you're used to getting what you want, you will just continuously try to get what you want, which is trying to get his Treasury Secretary to agree to take that job.
I don't think you want to do things that lead to an otherwise unwarranted tightening of financial conditions. And that's what you risk here. At a time when the economy is expected to pick up going into the new year, tax refunds, people are going to spend. It's a good story to tell right now, a better story if you're patient about it. You don't want to upset that. You really don't.
Patient? What was that word?
I know.
Patient?
I know.
Long term?
But misplaced, probably.
Not understanding this.
We're all impatient. Yeah. Equity futures right now in the S&P 500, positive by 1/3%. Coming up, Kevin Gordon of Charles Schwab. As stocks bounce back from yesterday to losses, Jason Furman of the Harvard Kennedy School on the political blowback from the Fed investigation, and Gerald Cassidy of RBC as Goldman and Morgan Stanley wrap up bank earnings. We begin this hour with stocks finding a firmer footing. And this is what Kevin Gordon of Charles Schwab has got to say, saying this week's volatility is proof of an I-shaped instability economy, writing unstable environments bring less reliable probabilities and forecasts because of rapid change. Kevin joins us now for more. Kevin, good morning.
Good morning.
We're seeing a lot of rapid change. How unstable is this environment?
It's, pretty unstable. I mean, it has been the norm for the past few years. I mean, you could argue for the majority of the post-pandemic cycle, but I think especially as we've learned, year to date, 2026 is only 15 days old, but it feels like a year. But, there has been a lot happening in the face of what has been largely a resilient equity market. Doesn't feel like it as much at the index level, especially in a cap-weighted index sense, but you look under the surface and there has been a relatively healthy move over the past few months. I think that you have to kind of parse it out between, it's not necessarily just a cyclical upswing in terms of the economy getting stronger all of a sudden because financials haven't been participating as much. So it's been a little bit more, geared towards some geopolitical instability evidenced by the move that we've seen in energy and to some extent materials. But I think that, generally the catch up in small caps, the catch up in the equal weighted indexes, not just at the S&P 500 level, but at the individual sector level, that has shown how the market has been relatively resilient, but also keeping in mind that the S&P 500 is not the ultimate gauge for how America is doing. So there is that distinction there. And when we wrote our outlook for this year, we were careful to point that distinction out. There is a big difference in a bifurcation.
Is it just a catch up? Or is this a sustainable rotation for the year ahead?
You know, I think something, especially for small caps, because that tends to be the focus a lot when you talk about a broadening and when you talk about a catch-up. There has been a meaningful shift in the earnings trajectory for even something like the Russell 2000. Often gets pointed to and painted at as this really sort of negative index and kind of low quality index because of the percentage of companies in there that don't have earnings. But you look at the turn and forward earnings estimates for the Russell, not just in absolute terms, but relative to the S&P 500. This is sort of the first time that we have seen a more durable and meaningful turn over the past few years. I think it's always a stretch to say, yeah, we could just extrapolate that out for the year. But at the same time, when you look at, just from a sentiment perspective, how hated small caps were last year, and you look at the flow statistics in terms of outflows from small caps into large caps, at some point that starts to work against the large cap bias and work more in favor of small caps.
Why? Why are profits going up? Is it because of efficiency and cutting back jobs? Is it because ultimately the bar is just so low that people are just excited that they see signs of life?
Yeah, I'll quote what the first thing that Lizanne ever taught me in this business, which is that when it comes to market and economic data, better or worse matters more than good or bad. So when you start to have a little bit of an inflection higher, that catches fire, and that tends to act as the spark and the catalyst. So again, it's not to say that this is just going to last in perpetuity. I think in Wall Street, we often think in terms of, it's an either or. You have to be all in on this or all in on that. That's not how it works in reality. So I think that, yes, that can happen in fits and starts. We don't expect this to be a linear move. But when you get to conditions that are so dour for small caps like we had last year, you have the sentiment component, you have the earnings component finally starting to turn. That tends to lead to a pretty durable move.
So upside earnings surprises could be the spark. Are Fed rate cuts the oxygen?
I think they help, but much to the conversation that you were having with Greg, I don't think that rate cuts are the elixir for what ails the economy. I mean, you can look at almost any chart of economic data, most importantly payrolls, put a vertical line at April of last year, and you can clearly see where a lot of the weakness started to kick in. So I think it's pretty clear that most of the stress probably rests on the policy side and what has happened in the past year. Not to say, though, that rate cuts won't help, but that's not what has been restricting the economy when you're sort of ranking things that have been. And I think that especially when you look at the nature of inflation in the post-pandemic cycle, most of it has been on the supply side, and it's been supply-driven. Some of that started to change in the back half of last year, where it has shifted a little bit more to the demand side. So that's where rate cuts do become more of an important player in that game. But I think we also have to respect the fact that this has been more of a supply shock-driven environment.
When it comes to policy risk, you mentioned the Lisa Cook ruling. Does that have more weight potentially on Fed independence than what's going on right now with Jay Powell?
It's tough to say because I think the Powell stuff is still so much in flux. I mean, we don't necessarily know how that's all going to net out. Nobody does because it's so new. But I think for the Lisa Cook ruling, yes, in the sense that if it does go against her, there is a pretty big chance for that to really change the construct of the Fed, not just for this administration, but in the future, especially because of governor terms specifically designed to basically insulate the Fed and the board from that political pressure.
Would that be a market positive? Because people would start to think potentially we get more rate cuts?
I don't think it would be. I think that, history is pretty consistent with the fact that if central banks lose their independent status in whatever form or fashion, that tends to be inflationary in the long term. I think that especially when, think about what matters most for central banks and for the institutions in any country, but especially the U.S. They matter most in times of crisis. So when you have a moment like early 2023, when you have 2020, when you have 2008 to 2009, that's when you look to them to provide, whether you agree with it or not, that's when you look to them to provide that kind of stability and stimulus or triage. So if you can't rely on that as much in the future, not saying that that's necessarily the case, but if that does become the case, then you weaken the credibility of any institution.
This is not moving the dial on expectations at all. In fact, tension really ramped up Sunday evening, and then what happened this week? Mike Friday, JP Morgan came out. You highlighted the note. He's not forecasting any cuts for the rest of the year, even with a new Fed chair.
Yeah, and right now the market really started to price that in, but then plateaued. So yes, they might not cut rates. It isn't necessarily going to be politically motivated. But at the same time, people are kind of looking at this and say, you're right. Markets have been shockingly stable. And you go to the question, is it complacency or is it a question of just looking through the noise and seeing if the market's going to win?
I don't know. But think about what essentially, Ferro is forecasting here. He's forecasting a new Fed chair being voted against every single meeting for the rest of the year when he comes on board.
Part of my problem with that is that means the other Fed members are not going to necessarily be looking at the economic data as much as they are trying to thumb their nose at the president. And I don't think that that's actually what we're hearing from the Fed members. I'm going to give them the benefit of the doubt that they actually are looking at the economic data. And unless you get some sort of a real rebound in the economy, otherwise they are on pace to cut for 2 more times this year. So unless something changes dramatically in the economic picture, are you really going to think that all the members are going to be that politically motivated against the Fed?
No, I'm suggesting that the economy, and I think this is what they're forecasting, is good enough not to cut interest rates. And they'll vote against any individual that's coming on board to try and vote interest rates when it's not warranted.
Yeah, I guess the question is that really the consensus right now on the Fed? And is that really what we're going to see in the data? And that might be the JP Morgan view, and that might come with some stimulus. But the real question is the economy that strong, especially if you do see the labor market picture?
I mean, JP Morgan has also seen the economy do so well that not even rate cuts are off the table for this year, but they're talking about a hike. 2027.
Kevin, you want a final word?
I would say that, in terms of the stability in markets, from Sunday night into Monday, the big distinction that has to be made is between front page risk and bottom line risk. For companies, for the broader economy, we've learned that even with tariffs over the past year. Yes, it was a huge front page risk at the beginning. It was a bottom line risk too. But then you had the dialing back and the series of delays, and now we've gotten to a place where we know that companies have been able to stomach it relatively well, of course, up the large cap spectrum. I would put the economy and the central bank right now in a similar position where there has to be a lot fleshed out in terms of Powell, in terms of Cook, before you can arrive at a definitive conclusion for what that's ultimately going to mean for the economy.
So diplomatic. Kevin, it's good to see you. Thanks for dropping by.
Guys.
Thank you, sir. Kevin Gordon there as Schwab. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Back with us is Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Taiwanese officials are heading to Washington to push ahead on a long-stalled deal to lower U.S. tariffs. Sources telling us here at Bloomberg, Taiwan's vice premier and top trade representative are expected to arrive as soon as today. It's unclear if a deal will be finalized and which U.S. officials will participate. Denmark's foreign minister agreeing to set up a working group after meeting with Secretary of State Marco Rubio and Vice President J.D. Vance in Washington yesterday. Denmark also announcing plans to beef up its military presence in the Arctic. Germany, Sweden, Norway and the UK are also sending troops to help protect Greenland from President Trump's takeover plans. A crew of 4 astronauts landed back on Earth after departing the International Space Station. They cut their trip short by about a month because of a medical issue on board. It's NASA's first ever medical evacuation of the ISS. The agency is working to accelerate the arrival of the next crew, which could arrive as early as mid-February. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, political blowback.
If suddenly the threat of a lawsuit can take a chair out of play, how can anybody think that that's anything more than a de facto ending the independence of the Fed?
A conversation up next with Jason Furman of the Harvard Kennedy School. Live from New York City this morning. Good morning. In the next 15 minutes, results, earnings from Goldman Sachs and likely Morgan Stanley into that. Futures positive by a third of 1% on the S&P 500, on the Nasdaq up by 0.8. Under surveillance this morning, political blowback.
If suddenly the threat of a lawsuit can take a chair out of play, how can anybody think that that's anything more than a de facto ending the independence of the Fed? And we all know what that does to markets worldwide. I will block any effort to name any member of the Fed board until this matter is resolved. It's either got to be fully adjudicated or they don't move forward with an indictment and they close the case.
It's the latest this morning. A growing number of Republican lawmakers breaking rank with President Trump as the Justice Department continues its criminal investigation into Fed Chair Jay Powell. Bloomberg's Tyler Kendall joins us now for the latest from Washington. That pushback really building, Tyler, over the last week.
Yeah, hey, John. Well, despite what has now become a list of Republicans raising concerns about the Department of Justice's investigation into Fed Chair Jerome Powell, President Trump maintains that he is unconcerned, telling Reuters that he thinks that these lawmakers should be loyal. In his words, I will point out that for the most part, the Senate Republicans who have come to Powell's defense aren't on the ballot this election year. Now, President Trump characterized this situation as a holding pattern, telling Reuters that as of now, he has no plans to fire the Fed chair, but said that it is too early to know whether or not this investigation will give him grounds to do so moving forward. Now, of course, as you well know, there is a very high legal bar to remove a Federal Reserve official from office, a protection that was bolstered by the Supreme Court. This White House would have to prove cause, typically meant to mean malfeasance or neglect of duties related to the job. Now, despite this investigation, the president maintains that he has plans to nominate a new Fed chair in the next few weeks. It had been our understanding that that announcement would come sometime this month, but it really could be complicated by these efforts on Capitol Hill. As you just heard from Senator Tom Tillis, he is threatening to block any nomination from advancing out of the Senate Banking Committee until the legal matter is resolved. And he really could, because Republicans only hold a 13-11 majority when it comes to Senate banking. Now, in terms of the other Republicans we have heard from, there's been perhaps a little bit more of a measured response, but Dave McCormick, also Kevin Cramer, two Republicans on that committee, say that they do not think that Powell committed a crime. John, we'll have to see how much this escalates. Congress does have some other tools that they could invoke. I'll point out that Senator Lisa Murkowski, a Republican from Alaska, is now calling on Congress to investigate the Department of Justice's investigation.
Tyler Kendall in Washington. Tyler, thank you. Let's talk about those unintended consequences. Jason Furman of the Harvard Kennedy School has this to say on the Fed probe. It will also raise the hurdle for whoever Mr. Trump nominates as the next Fed chair, and it will make other members of that body a lot less likely to go along with the president's agenda. Jason joins us now for more. Jason, welcome to the program. Unintended consequences. We've not seen a tightening of financial conditions off the back of this pursuit over the last year. Jason, would you call that complacency or just faith in the institution, the resilience of the Federal Reserve?
I think that largely reflects faith and resilience. There was that brief moment last year when it looked like Donald Trump might be ready to fire Jay Powell. Markets really did trade on that. But once they got reassured, and they've gotten increasingly reassured by the courts, by the Senate, by others, I think they're correctly reading the Fed's independence, at least in the short run.
Jason, if you were in the White House, would this mean that the individual the president picks, the credibility of that person, the bar just got a lot higher?
Absolutely. I mean, I would have wanted a very credible person to begin with. Ken Rogoff wrote a famous paper, I think 40 years ago, that basically said you want a more conservative and credible central banker, even than you yourself are conservative and credible, and it will benefit yourself to have that and have that at arm's length. I wish President Trump understood that.
Do you think the potential of Jay Powell staying on to continue his term as governor has now increased because of what is going on with this subpoena?
It's absolutely increased. I mean, he'll have to watch what happens to the Lisa Cook case in the Supreme Court next week and what the administration's follow-ups are there. He'll have to see what the new chair is and how they're running the committee. We're used to thinking of this as a chair-dominated place, and we talk about what the chair wants to do. There are 12 voters there. We've seen an increasing number of dissents, and this whole process is only going to encourage even more dissents against the chair. The less credible they are, ironically, possibly the less ability they're going to have to deliver what Donald Trump wants them to.
Jason, it's incredibly ironic that this dispute and the subpoena was over the Eccles building. The last Fed chair to stay on as governor after being Fed chair was Mariner Eccles, and this was in the immediate aftermath of World War II to try to keep some sort of independence. It also was at the time of the creation of Bretton Woods. Do you see this as an analogous period in history for the Federal Reserve where it reshapes the way it really is perceived?
I think it's less reshaping the way it's perceived and more sort of double tapping and locking it in. Eccles was at a time when, and even for the next several years, the Fed worked closely with the Treasury. It actually wasn't independent. We had fiscal dominance. They kept interest rates down to help us deal with the post-World War II debt. Now Powell has been handed a Fed that's enormously independent, enormously credible, and his job isn't to forge something new, but keep that. And he's doing a very, very good job at keeping that.
You could argue, Jason, that regardless, this is going to be a more politicized era for any central bank, given how much debt there is and how instrumental the rate-setting policy is to the interest expense of the country. I mean, at what point should that be part of the Fed's mandate to sort of keep that within control by all means necessary in order to both reduce funding costs, but also with an eye on inflation? I mean, why is that not an appropriate way to set policy?
Look, there's a great way to reduce the federal government's interest bill, and that's some combination of raising taxes and cutting spending. And the more the political system thinks that there's some other way through the Federal Reserve, the less likely they are to raise taxes and cut spending. So that's, in some ways, I actually think our fiscal situation makes it even more important to make it clear to the political system that the easy path is not there. They need to take, unfortunately, the somewhat harder, but much better for the economy in the short, medium, and long run way out of this.
My understanding is that the subpoena was delivered on Friday. The chairman decided to release a video as the markets were opening in Asia Sunday night. Did he increase the stakes with this rare video message? Could he have just replied to the subpoena?
Well, he could have handled it in all sorts of ways. I think he handled it absolutely brilliantly. He's not somebody who is eager to be out there. This is not a resistance lib. This is someone who has a lot of credibility with markets, with former economic policymakers. I joined a statement with a lot of them on this, with senators, as you were just hearing on your show. And the fact that he felt the need to speak out and do it in this way signaled to all of these people, this has gone way past where we were in Trump's first term when he was just doing mean tweets about Jay Powell. It's much, much more serious, and he alerted us to that.
I guess my question is, though, did he make it more political as well?
In some ways, he made it less political. Look at how bipartisan the reaction has been on his side. And even the administration is digging in and defending this much less than they usually dig in and defend the things they're doing. I think he handled this in a very appropriate, professional manner. And yes, in some sense, it is a little bit political, but it's not partisan politics. It's using political skills to defend a very apolitical institution.
Jason, just finally, I think you'll find broad consensus, of course you will, on Wall Street about the benefits of operational independence. Something about Sunday and the following 24 hours did make me feel somewhat uncomfortable, though. It felt like that these guys were just untouchable, that you had all this support worldwide. Jason, how do we maintain a degree of accountability, even as we look to preserve independence?
Look, normally on your show, we'd be arguing about should they, cut rates by 25 at the next meeting, not cut rates. There's an enormous amount of criticism of the Fed constantly, incessantly from everyone, as there absolutely should be. These are really tough decisions. A really robust debate helps those happen. They testify to Congress, et cetera, et cetera. So this is not an institution operating in secrecy, independence with no comment. It is not above reproach. It just is above being teared down in the way that Donald Trump wants to tear it down.
Jason, appreciate your opinion this morning, sir. Thank you. Jason Furman there of the Harvard Kennedy School. Just getting some big results from Goldman Sachs. I'll go through a couple of the headlines and we'll come back in just a moment. Equities trading revenue coming in at $4.31 billion. The estimate $3.65. Fixed sales and trading revenue coming in at $3.11 billion. The estimate $2.95. The stock is higher by 0.4%. We'll get the view of Gerard Cassidy of RBC in just a moment. From New York City, you're watching Bloomberg TV. Live from New York City this morning. Good morning. Wrapping up earnings on Wall Street. Morgan Stanley, Goldman Sachs had just moments ago. Futures positive by 1/3 on the S&P 500. Some very large numbers coming out of Goldman. With the latest results, let's cross over to Danny Berger. Hey, Danny.
Hey, John. It's a beat for Goldman Sachs. Let's go through the main numbers here. Fixed sales and trading for the fourth quarter beating at $3.1 billion. The estimate was for just under $3 billion. Equities trading, that comes at $4.3 billion. The estimate for that was $3.6. They're also going to be increasing their quarterly quarterly dividend. The investment banking revenue, that comes in just below the prior quarter, $2.58 billion. This is a segment that executives had been flagging as animal spirits reawakening, deal pipelines looking strong. So the fourth quarter, a little bit weaker than the third. Maybe it's like of the likes we saw from JP Morgan where things have been delayed. One of the reasons you're seeing Goldman shares little change might be because of this. It's something that weighed on the other bank results. It is their total operating expenses. Those come in much higher than expected. $9.72 billion. The estimate was for $8.8 billion. So again, maybe that's why you're seeing Goldman underperform. It is the best performing bank over the past year of the big six banks. Let's compare that to Morgan Stanley. Now you can see there, Morgan Stanley, that is doing better today. Expenses did come in less than expected. You're looking at its equities trading revenue. This is interesting. Coming in below Goldman Sachs. To remind you, equities trading at Goldman Sachs is $4.3 billion. At Morgan Stanley, it was $3.7 billion. The reason this is interesting is because Morgan Stanley had taken back the equities trading crown. It looks like they are now ceding that to Goldman Sachs. Their debt underwriting, this is also a huge push from the new CEO, Ted Pick. That is a handily beat. $785 million is their debt underwriting fee they've garnered for their investment bank. The expectation was $635. So in these parts that it counts, debt underwriting, wealth management also outperforming. Numbers look very solid for Morgan Stanley, John.
Danny, appreciate the update. Let's cross over back to Goldman Sachs. Several lines of businesses to drill down on. Let's just pick out one issue. Equity trading revenue, not an issue at all. Todd Gillespie of Bloomberg wrote this one up for us, netting an all-time Wall Street record for the final 3 months of the year.
Yeah, you saw for just in terms of equities trading revenue, $4.3 billion. The estimate had been $3.65 billion. I mean, they beat by almost $1 billion. I mean, just to sort of point out how significant some of these are. And it raises a question, especially given that their investment banking also beat, whether you actually are seeing a slowdown or whether competition is getting very stiff, especially among some of the banks that are traditionally the investment banks. It is interesting that expenses really is front and focus. It just shows that after the best performers have had such an incredible year, people are looking for the pitfalls more than they are the positives. That, you know, Goldman Sachs even increased their target for their wealth management business at a time where they see that coming as well. And they don't even have the Apple Card to worry about.
Goldman Sachs up by 0.2%, Morgan Stanley up by 1.2%. They don't have to talk about the credit card business on the call. That's probably good news.
They probably can do a victory lap. They'll say, yeah, we got rid of it just at the right time. You're welcome.
Jared Cassidy of RBC joins us now for more. Jared, welcome to the program. Look, decent numbers from those two companies, and we've seen this through much of this week. This is what we saw from JP Morgan. OK results, stock down 4%. Bank of America, pretty decent, stock down almost 4%. Same with Wells, same with Citi. And Jared, Morgan Stanley and Goldman Sachs putting up some massive numbers, and the stock's barely moving. What's the takeaway, Jared, from this week?
John, part of it is obviously what we saw with the comments about limiting credit card interest rates. That's what's affected the names you mentioned, the money centers that reported earlier in the week. But when it comes to Goldman and Morgan Stanley, obviously they don't have credit cards. And what I think the action is showing us today is that we've built into the models some very strong numbers, and the stocks, as you both know, have had a very good year in 2025, and their valuations today are very rich. So the high bar that's out there, they met it, but they didn't greatly exceed it like they were doing all of last year.
Jared, what does that mean, not for the outlook for the company, but the outlook for the stock for the year ahead?
John, it's a good point, and we've been advising investors that we think the play for 2026 is financial, so we're still there. But we think the leadership may change to the regionals, to what you just brought up. Again, the investment banks have put up very strong numbers, but we've already baked them into the models. So when you think about the second derivative, John, the rate of change year over year for the investment banks is going to get more difficult through the year, whereas in the regional banks, I think it's going to improve. And I think that's what people are now contemplating.
I'm going to ask the TMZ question of the morning. Who won, Morgan Stanley or Goldman Sachs?
Well, I don't want to go make a tough decision, but they both did very well. So I would say that both companies, if you look at different parts of their business, the advisory business at Morgan Stanley was incredible this quarter. And at Goldman Sachs, you guys have touched on it. The trading business, equity trading, very good. So they both had standouts. So they're both, top tier. I guess if you had to choose one, you probably would choose maybe Goldman over Morgan Stanley, but they're both very good.
Do you think that they're actually winning share from the likes of the JP Morgans that talked about deals getting pushed into 2026, given that they both beat on some of their investment banking revenues and JP Morgan actually missed?
I would say that I don't know if they're taking share because those top 5 banks are all very strong. They might be taking share, though, Lisa, from the investment banks and the trading firms that are ranked anywhere from 10 through 15. That's maybe where they're taking share. But amongst the big guys themselves, I'm not so certain they're taking much market share away from one another. And it also changes quarter to quarter. The long-term trends, the bigger banks are getting bigger. Economies of scale are very important in the trading businesses.
It also seems like there's a bifurcation right now, Gerard, versus companies that have banks that have a bigger exposure to consumers defined as mom and pop stores and just individuals who want to buy cars and homes, and banks that have consumers that are high net worth individuals that want to put money into a variety of different assets. How is wealth management kind of the maker or the breaker of so many of these companies?
Lisa, you're making a good point because we've seen from the analysis by the Department of Commerce and others that the top 10% of households in America account for about 50% of consumer spending. And as you know, consumer spending is 2/3 of the U.S. economy. And that ties into the wealth management businesses. And when you look at all of our estimates, including my own, in January of 2025, of these investment banks as well as the money centers, and then you look at the actual numbers at the end of 2025, the upgrade or the increases in estimates were driven by investment banking, trading, but wealth management. Wealth management had a very strong year last year. JP Morgan's wealth management business has a return on equity of about 40%. That's incredible. It's been a very profitable business for the players in that market.
Jared, the political backdrop was meant to be a fertile environment for some of these big names on Wall Street. And we've seen that in the stock, reflected in those names, the rally we've seen over the last 12 months. Is there something about the change we're seeing to the political backdrop in a midterm year with the focus on affordability that lends itself to your idea that the long trade in financials might be somewhere else away from these big players?
I think, John, the underlying theme out of Washington, regardless of what we just saw with the comments about the credit card interest rate cap, is deregulation. As Treasury Secretary Besson has been very clear, they want deregulation, and we're seeing it. The regulators are deregulating the banking industry. The big one's coming this quarter, we believe, the Basel III endgame. It will be less onerous than what we saw in the summer of 23. So that long-term trend, people should not overlooked because it is in place, it's continuing, and there was a big distraction, of course, this past weekend with the interest rate cap. But we think that's political, that's not structural. You think that's just a distraction, though, Jared? That's not the story for the year ahead? I do think it's a distraction, John. I really do. I'd be surprised. Don't get me wrong. There will be a lot of discussion about it. But when you look back, you think back what happened, the big banks are already saying, if you force us to lower the rates to 10% across the board, we're going to have to cut back on extension of credit. And John, look what happened during the Carter administration. When they did that in 1980, they cut back on consumer credit. We immediately went into a major recession, which they quickly changed. So I really would be surprised if that goes through.
Well, your memory is a lot longer than many of those in Washington. Maybe the credit card interest rate cap might not go through, but there's a lot of momentum right now, and there has been for really years, but potentially the president could push over the finish line when it comes to competition with swipe fees. What would that do to the sector, Gerard?
That's true. There's always been the debate over swipe fees. You might remember something called the Durbin Amendment that was passed about less than 10 years ago. And they were supposed to pass on the savings to the consumer, which is really tough to figure out if they did. But yes, the swipe fees that are under pressure, that is a trend that's likely to continue. And that would certainly lower some of the profitability for the credit card companies. And yes, competition is increasing from the non-banks, the fintechs, and the big banks are obviously gearing up for this new increased competition.
Jared, thank you, sir, for catching up with us over the last couple of mornings on the financials. Jared Cassidy there of RBC. Danny's got a recap of everything. We can ask Lisa's question to Danny because she'll answer it directly. Danny, you can wrap up the quarter for us. The big banks on Wall Street, the results are in. Who won the quarter this quarter?
Oh, can I answer that? Look, if it's talking about trading, it's got to be Goldman Sachs. But if it's based on expectations, Morgan Stanley is outperforming everywhere that they needed to show up. They needed to show up on debt underwriting. This is something that Ted Pick has really emphasized. And show up they did, easily beating expectations. Their asset management business, this is the crown jewel. We're talking about margins, pre-tax margins at 31.4%. They pulled in a bunch of new assets, $122 billion in the fourth quarter, saying that it was driven by higher assets all around. And I should just emphasize that Goldman Sachs also putting a lot of focus on their asset management business in this quarter, too. Again, because of margins. Their margins are also looking at something like 30%. That's up from the mid-20s just a few years ago, setting really big goals when it comes to both fundraising and a goal of by 2030, $750 billion under management. But again, the eye-catching one, it has to be this trading figure from Goldman Sachs when it comes to equities, $4.3 billion compared to an estimate of $3.65 billion. It's been a battle between Goldman Sachs and Morgan Stanley on who has the bigger business. It's been going back and forth repeatedly. Morgan Stanley won it for 2 consecutive quarters. Goldman retains the crown this morning.
It's a massive number. Danny, thanks for the recap. Appreciate the wrap up. Thank you very much. Morgan Stanley, by the way, in the pre-market up by more than 2%. Morgan Stanley last year, Lisa, higher by more than 40. The rally continues this morning.
Yeah, so they were up by 38% in the past 12 months. But Goldman Sachs was up by 54%. Do you know that I suspect that in the C-suite they have a dartboard in Morgan Stanley with Goldman Sachs throwing it at it, and
what,
with
faces
Goldman
of
Sachs,
Solomon and Pick
with Morgan Stanley.
Bramo, what's wrong with you?
Gone dark.
Brutal. Why do we have to make it so dark?
No,
Fantastic numbers.
I think that they really enjoy the competition, and I think that this is clearly they're neck and neck and both enjoying this environment. I had to ask the TMZ question. That's what everybody always does when these come out, but the truth is they both had pretty incredible quarters.
That wraps up the earnings on Wall Street for you. Morgan Stanley higher by 1.7% in the pre-market. With an update on stories worldwide with your Bloomberg brief, let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hi, John. Well, let's recap those figures. Goldman Sachs and Morgan Stanley rounding out this big week when it comes to bank earnings, the universals at least. Goldman reporting global banking and markets net revenues for the fourth quarter that beat the average analyst estimate. Morgan Stanley posting a beat as wealth management net revenue exceeded expectations, and shares of both, as you can see, higher in the pre-market. Amazon is challenging Saks' bankruptcy financing. The online retailer is claiming the department store chain breached a deal and that its $475 million equity investment is, quote, presumptively worthless. In 2024, Amazon took a minority stake in the retailer as part of an agreement that helped facilitate Saks' acquisition of Neiman Marcus. Richemont sales jumped to a record in the final months of last year. The company's jewellery division saw 14% growth in its fiscal third quarter, topping expectations. Cartier is experiencing a strong boost in popularity with celebrities like Taylor Swift and Timothée Chalamet helping boost demand. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you very much. Up next on the programme, betting on the bulls.
We're risk on right now as we start 2026.
This is a market that's very hard to depress.
There's no bears when it comes to strategists, and there are certain signs of complacency.
Up next, we'll catch up with Jason Thomas of Carlisle. Live from New York City, you're watching Bloomberg TV. Stocks are positive here across the board. We're higher by 1/3 on the S&P 500. On the Nasdaq 100, up by 0.8%. The outlook from TSMC in Asian trading really lifting tech equities. So that's the story on the Nasdaq. The story for the financials this morning, these two names right here in the last 20 minutes, Morgan Stanley and Goldman Sachs. A record equity trading call from Goldman Sachs, a record for Wall Street for the final 3 months of the year. That stock is still down by 0.9%. Given the rally we've seen after the last 12 months or so, this is what we've seen all week from the financials. Even those that put up fantastic numbers, the stock is trading lower. There's one exception, and we'll see if this move sticks. Numbers from Morgan Stanley. The stock is up by 1.8%, a solid quarter from Ted Pick and the team.
Yeah, and it really has come across the board, in particular wealth management. And wealth management has been the jewel, with revenue coming in at $8.4 billion versus $8.3 billion expected. This, to me, is really going to be the key. How much is this going to be a question of some of these banks proving that they are poised to truly outperform in an environment that seems to be increasingly tricky for the remainder of this year?
Morgan Stanley trading higher in the pre-market so far this morning. Under surveillance this morning, betting on the bulls.
We're risk on right now as we start 2026.
There is still room to run here.
This is a market that's very hard to depress.
There's no bears when it comes to strategists, and there are certain signs of complacency.
We think people are sleeping on the macro risk. This is not going to be smooth sailing for 12 months of the year.
So here's the latest this morning. Wall Street expecting the US stock market to rally for a fifth consecutive year. Jason Thomas, the head of global research and investment strategy at Carlyle, writing, heading into 26, the consensus view is broadly constructive. Rather than simply accept it, we want to test its durability. Jason joins us now for more. Jason, really thoughtful outlook for the year ahead. Let's get into some of this. How are you testing the durability of the consensus view?
Well, I think we would start with Fed policy. Right now, there's expectations for 2 rate cuts. That seems reasonable. But if you look at options, the options markets on forward rates on futures imply that 7 cuts are as likely as 1 hike. So it's essentially a market that really is not at all worried about higher rates and thinks that there's some potential for rates to be by 2% by year end. What I find interesting is that this comes at the same time that all anyone in Washington, D.C. can discuss is affordability. So here you have a federal agency that is tasked with price stability, that is expected to ease policy somewhat and potentially quite a lot, depending on change of management. At the same time that voters, the electorate, is really quite upset about what has been a cumulative 25% increase in consumer prices over the last 5 years. And so I wonder, as we approach the midterm election, to what extent some of these concerns about affordability may essentially bleed over onto Fed policy and policymakers, elected officials start to wonder why it is that policy is moving in an accommodative direction, or perhaps if policy is already too accommodative.
So, Jason, I want you to sort of build on some of this, because the push coming from the White House right now is actually for lower interest rates. The Federal Reserve, as you know, can do something about the price level. I imagine a lot of people won't like it. And what it could mean ultimately is a lot of unemployment and much, much tighter financial conditions. Is there any reason they'd move in the latter direction and not the former?
Well, I think that obviously when you look at the movement in rates since September of 2024, when the Fed first started this cutting cycle, you have base rates that are now down by 175 basis points. That's great. But of course, you have a 10-year yield that's up by about 45 basis points over the same period of time. So when you look at the economically sensitive interest rates further out on the yield curve, there hasn't been much movement. And I think that is, you could have a situation where seemingly tighter policy, being less likely to cut short rates, actually is something that causes term premia to compress and guide some of those longer-term rates down, which, of course, would be quite helpful to the mortgage market, to broader discount rates, and, again, those economically sensitive financing costs.
Do you think that this is an overly complacent market to the upside, given the fact that potentially you could see exactly what you're talking about, that the politicization of the Fed could potentially even keep them on hold for longer, which could mean that actually term premia compress and it actually gives a tailwind to some of the benefits that we're seeing in markets?
I just find the independence debate interesting because, again, we always think of it in terms of having a Fed that is free to plot its own course, not do the bidding of elected officials. But also there has been some insulation from political pressures, which is to say that over the last 2 years, there's been an asymmetry in Fed policy. Inflation, which they haven't hit their inflation target in I think, 57 months, is always explained away. It's transitory. Oh, this is just tariffs. We're looking through that. Where there's any signs of weakness in the unemployment market is met with a very forceful response. I think back to October, November of 2021. It was the first time in my career where a Fed chair was testifying in front of Congress, and you really got a palpable sense that the members of Congress were much more hawkish than he was. That they were asking, why is it that you've not moved policy as yet? Why not just increasing interest rates, but why are you still purchasing assets at this clip? Of course, that was when the Fed pivoted. Several months later, March 2022 is when they first raised rates. And so there is not just this question of independence, again, the ability to act of your own accord. There's also a question of, well, if the voters are really upset about the way that you've allowed cumulative inflation to so far exceed target, don't you have some obligation to take that into account when setting policy?
Jason, based on that, would you take the other side of the Sell America trade? Would you say that actually you are bullish on the institution, considering the fact that there has been this insulation to some of the political influence at a time where the consensus right now is to look outside of the U.S. and to diversify abroad?
I think that in the United States, what we see is a diversification into cyclicals, into value. So in the market itself, it's not simply sell America, buy the rest of the world. Obviously the valuation ratios are cheaper elsewhere, and that attraction I certainly understand. But there's also a lot in the U.S. that looks cheap. And you see this year, there has been a fairly sizable rotation into some of those other sectors, and we may see that as well. And I think just generally this very positive market backdrop, the degree of optimism that you see in virtually every strategist report is something that actually suggests there's a lot of room to run in value and cyclicals going forward. I would also note that speaking to some large capital allocators at the end of last year, I think they started to get somewhat uneasy, recognizing that virtually all of their incremental risk budget has been consumed by data centers and other AI thematics over the last 18 months. So I think that there could be also a rotation where you're selling down some of that exposure and trying to diversify again into value cyclicals elsewhere in this economy.
Well, PIMCO told the FT today that given the quite unpredictable environment of this administration, they're having a multi-year period of diversification from the U.S. Do you think if anyone starts to diversify, it'll be for many years?
I think it's a long-term process. Again, initial conditions are so important to keep in mind because at the start of last year, you had the U.S. equity market that accounted for an all-time high of global stock market capitalization, with many indexes, the U.S. up from about 45% a decade earlier to 2/3. You had a dollar on a real exchange rate basis that was about 25% above longer-term trends. So, this a long-term process of diversification is quite understandable. I do think the administration would not, they would not have a problem with some gradual dollar depreciation from here. Again, that could be effectuated by some of that diversification. So, yeah, I think on a longer-term basis it's reasonable, but I don't think anyone should panic about that or look at it as especially troublesome because, again, the U.S. was so overweight in virtually every portfolio.
Jason, always thought-provoking. Appreciate your time today. Thank you, sir. Jason Thomas there of Carlyle on how the remedies to the affordability crisis might shape market outcomes. Something for us all to think about going into the year ahead. Up next, we'll catch up with Jonathan Golub of Seaport Research Partners.
This is a market that's very hard to depress.
Some of the weakness is going to get overlooked in Q4, but the outlook has to be optimistic for this rally to continue.
You have a really good environment, I think, for cross-market positioning.
There'll be winners and losers.
I do anticipate that this quarter we will continue to see some broadening and rotation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. A better morning for tech, thanks to TSMC. The Nasdaq 100 is up by 0.9%. Equity futures on the S&P 500 up by 0.4%. Check out the banks. All the banks that have reported over the last couple of days, no matter how good the numbers are, have traded lower by the end of that day. There is one exception so far this morning, and we will see if that sticks. It's Morgan Stanley, and it's higher by almost 1%.
Yeah, and it comes after they also came out with huge quarter in terms of just what their revenue is, net interest income, investment banking. At the same time, how much is this just where the bar was versus what they delivered more than anything else, because you could say this about any of the banks. I mean, you get the numbers in a vacuum, and you couldn't have predicted the results in terms of what the market's response would be. The bottom line is they're minting money, they're doing very well, and it's a question of how much people expect that to continue and how high the bar was heading into this.
Over the last 12 months, the previous year, these are names that rallied 20, 30, 40, 50%. Year to date through last year. Trying to add some weight to that for Morgan Stanley, it's an effort. We're up by 0.9% for that name in the pre-market. It's also why people like Gerard Cassidy of RBC is looking elsewhere. He's saying, yes, the companies are doing well. They'll continue to do well. But because of the rally we've already seen, he's looking to the regionals and the smaller players.
And that's what you've seen more broadly in markets, because the large caps more broadly have been doing so well that people are looking beyond some of the smaller companies, small caps, equal weight, and that is true very much in the banking sector as well. I also do wonder about the costs, and Danny mentioned this, and I think that this is an interesting one. How much costs are increasingly in focus, even as banks say we need to spend a lot on AI to keep up. People in the market are still skeptical, which is interesting at a time of efficiency where they're talking about cutting back on the margins in their staffing.
They're in focus in the firing line down in Washington, D.C. as well, and that's a change.
Yes.
One of the long trades, I think, of the last year has been the financials, primarily because, and not just because the economy was okay, but primarily because of the regulatory backdrop. Just feels like there was a bit of a turn in the last few weeks on that front.
Last year was all about deregulation, this excitement for mergers and acquisitions and IPOs and all those to pick up, and the deal makers, the banks, being able to get some of those fees. This year, we're starting the year with targets on their backs when it comes to credit card fees. The president talking about potentially wanting this idea of capping interest rates on credit cards at 10%, and then also putting out on Truth Social, take a look at Senator Roger Marshall's bill that's been there since 2023 when it comes to competition in this space. Something might get done, maybe not as aggressive, but something might get done when it comes to credit cards as the president is gearing towards the midterm election, and he's calling people on the very far left to join with him to get this over the finish line.
This was a big consensus long for the last couple of years, and I would just say sentiment, bullish sentiment, just slowly chipped away at by Washington, D.C. over the last week or so. Morgan Stanley's doing okay, just about. We'll see if this holds. We're up by 0.4% in the pre-market. Coming up this hour, we'll catch up with Jonathan Golub of Seaport Research Partners as stocks bounce back. Republican Congressman French Hill as big banks are pushing back against President Trump's credit card cap. And the Continental Resources Chairman Harold Hamm as the U.S. officially begins selling Venezuelan crude. We begin this hour with stocks edging higher, aiming to recover from their first back-to-back losses of the year so far. Jonathan Golub of Seaport Research Partners is one of the biggest bulls on the street, expecting the S&P to reach 7,800 this year. He writes, we're increasing our 25 to 27 earnings forecast to reflect recent strength in surprises and revisions. Jonathan joins us now for more. Jonathan, good morning. Good to see you.
Good morning.
Let's get into the importance of earnings. I've said this a few times over the past few weeks, that if you ask people to guess what drove returns in the last 12 months based on headlines, that have said it must have been all multiples. Everyone was worried about bubbles, but it was all earnings, or albeit most of it was earnings.
Yeah, matter of fact, I would take the opposite side of the conversation on banks. Last quarter, not banks, but financials broadly, grew their earnings 25% year over year, and it looks like this quarter is going to be only probably low double digits. But that's half the growth rate, and so it really is earnings. Tech, of all things, the earnings grew 7.5% faster than the prices went up, and tech became substantially cheaper as the year went on. It's all about earnings.
Deceleration matters, though. Why do you think, even with a decelerating earnings profile, close to double digits, which any other year would sound great, but off the back of the year we've just had, maybe it's not that good, why is that still supportive for equities?
Well, first of all, if you look at the single most important thing is what we call revisions, the change in estimates. It's not the growth rate. So far, this, if you look at this quarter or the full year 2026 estimates, have been rising dramatically. What it says is that analysts continue to underestimate, in particular, the growth potential of these big AI tech names. But even the broad market, the estimates keep getting ratcheted higher. So it's typical that analysts come out with their estimates for 26. They're too high and they fall over time. Those estimates are doing something very unusual. The estimates are actually being adjusted up, not down. And that, I think, is probably the most important thing.
So I'm confused. Take a step back. You're saying that, okay, yes, there is this upward revision when it comes to the earnings, but it's a downward reality versus the end of last year, at least when it comes to the big banks. Are you saying that the move lower is justified or not on some of these financial stocks after really incredible earnings?
First, I would be leaning into the financials. I think that there was a theme that you talked about in your last segment with Jason, which I think the difference between 25 and 26 is the focus we're going to have on the midterm elections. And it's all about this affordability concept. And it's not about the Fed tightening things up. It's about the administration and Washington putting money in people's hands. This whole discussion about credit cards is to say, I hear you, Mr. Consumer or Mrs. Consumer, we're going to give you some relief. Home affordability is a really big issue. I was just looking at this on my Bloomberg terminal yesterday. So what do? You buy $200 billion worth of mortgages. You force the banks to hold more of it. I would expect to see that under new Fed leadership that you're going to see this whole rolling off of mortgage paper. That's going to get changed. And I think that what you're going to feel is at least a strong gesture that the consumer is being heard as an election issue. So the financials are going to be front and center. The credit card issue is not a positive one, but it's still part of a theme, which is we need to help the consumer.
And they're going to find a way to do that while not necessarily kneecapping the banks. That's sort of the point that you're making. I am wondering if there's a bigger question underpinning some of these earnings results, in particular from Goldman Sachs, where they delivered an unprecedented year in equities, and yet people are focusing on operating costs that are rising 18% year over year. Do you think increasingly that is the right tactic to take, to penalize companies that are spending significantly more as they try to build out their tech and beyond?
I don't think that's where the focus is going to be. I think the focus is going to be on a continuation of a strong M&A environment, which puts a backstop under smaller companies in particular. It's one of the reasons why small companies, non-earning small companies, had a great year, because the market was saying is we can, there's a backstop in that you can be bought in an M&A transaction. I think that corporate credit, as long as it's behaving well, is going to do well. And I think spreads are going to surprise everyone again and be tighter. We can take a pinky bet on that one. You'll be on the other side of my trade. But last year, again, right off the Bloomberg terminal, you had a decline in high yield spreads, and nobody thought that was possible. It's all about the backdrop for a functioning economy, and all indications are it's going to be supportive.
Well, it's a midterm election year, as you pointed out. Which industries do you think will do well or not do well, and how do you game that out? The president, you mentioned housing, you mentioned credit cards, but the president also told the defense sector he doesn't want to see buybacks and dividends.
I think there's going to be two very disparate themes. I think one is the tech companies right now look like they're going to deliver very strong earnings growth. Again, something it's going to probably be in the mid-20s, which compared to the rest of the market that may be low single digits, that's an enormous number, and it's very hard for it not to do well. Separate from that, if you believe that we're going to address affordability, there are two sectors in focus. Consumer discretionary is going to surprise to the upside. I would watch housing. The housing stocks popped really big a little while ago when you had this buyback, this purchase of mortgage discussion. I think that's an area that's going to continue to do well. It's not only the home builders, the whole suite of housing stocks is going to do well. And the financials, putting aside the current conversation about credit cards, the only way to boost the consumer is to make credit available for the consumer to purchase.
Let's finish by making it really simple for those at home right now. They just want to sit in the index, market cap or equal weight. What is it for the end of the year?
I'd have to say it's not going to be as big as it's been in the past. I would say probably the cap-weighted benchmark.
OK, going against the early grain of the start of 26. Jonathan, it's good to see you.
Good to see you.
Thank you, sir. Jonathan Golub there of Seaport Research Partners. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Republican Senator Tom Tillis telling Bloomberg he's concerned the DOJ's criminal probe threatens Fed independence. Tillis says he'll block Fed nominations until the investigation is resolved. In response, Senator Tillis and other GOP lawmakers who are critical of the Fed investigation, President Trump saying, quote, I don't care and they should be loyal. The U.S. State Department is set to stop issuing immigrant visas to people from 75 countries. Sources telling us here at Bloomberg the order is likely to target foreigners that authorities believe could require public assistance while living in the U.S. Impacted countries include Brazil, Somalia and Iran. Amazon is utilizing an Arizona mine to meet its data center's need for copper. The tech giant signed a 2-year supply pact with Rio Tinto's Nuton venture. However, the Nuton copper will satisfy only a sliver of Amazon's needs. As part of the deal, Amazon will supply Rio with cloud computing and data analytics. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. More from Bonnie later this hour. Up next, the Morning Calls Plus. Republican Congressman French Hill as big banks push back against President Trump's proposed credit card cap. Live from New York City this morning. Good morning.
We think the play for 2026 is financial, so we're still there. But we think the leadership may change to the regionals. The investment banks have put up very strong numbers, but we've already baked them into the models. So when you think about the second derivative, the rate of change year over year for the investment banks is going to get more difficult through the year, whereas in the regional banks, I think it's going to improve.
That's the call from Gerard Cassidy of RBC following some big results from big banks this week that have not delivered big gains to the stock market, at least over the last few days. Equity futures still elevated, though, up by 0.4% on the S&P, on the Nasdaq 100 higher by 0.9. The likes of Morgan Stanley very much in focus. Bramo tracking the stock price in the pre-market. Numbers great. Stock price reaction, meh. Stock's up by about 1/4%.
Honestly, this is the reason why I was saying I can't give you a reason. I mean, yes, you could look at the earnings and come up with some kind of number like this: $785 million. That is the debt underwriting revenue that came in for the last 3 months of the year. That was compared to $635 million. It was expected. You can point to all these things, but all of the banks have those numbers. This is the thing. So trying to create a narrative that actually hangs together and lasts to the end of the trading session is going to be very difficult.
That's why I keep asking. I don't want your outlook for the company. You're going to tell a great story. There's a good story to tell. I want your outlook for the stock. It's already rallied so much. And we often say on this program, you can learn something from the information and learn something from how the stock responds to the information. You're learning a lot from the latter right now.
Right now, what you're learning is that people are worried and they want to see whether they can actually see the same kind of growth rate. I mean, the fact that Goldman Sachs raised their dividend by 50 cents and that people are just like, meh, show me something else. They delivered on a whole bunch of different metrics and still people are not impressed. Highlights that people feel like maybe these shares have gone a little bit too far, too fast over the past 12 months.
Early days. We'll see how these stocks respond as the session grows older. At the moment, we're positive by only 1/4% on Morgan Stanley. That's the price action. Let's turn to your morning calls. First up, Barclays upgrading Dow to overweight, noting strong orders for its AI servers. Your second call from Wells Fargo upgrading Broadcom to overweight, seeing upside from Google's TPU demand. And finally, Bernstein raising its price target on Boeing, naming it the firm's top aerospace and defense pick for the year. Let's turn to Washington. President Trump reaching across the aisle, asking Democratic Senator Elizabeth Warren to support his effort to cap credit card interest rates at 10% after facing opposition from his own party. The Republican Congressman French Hill, chairman of the House Financial Services Committee, joins us now from Capitol Hill to respond to that and a whole lot more. Congressman, it's good to see you, sir. History is littered with examples, full of examples that when you introduce price controls, you end up with restricted supply. Congressman, is this proposal going to end up any differently?
Well, happy New Year, Jonathan. Great to be with you. Congratulations on becoming a dad. So happy for you and your family. Look, this proposal is a price control, and I think I've heard from Republicans in the House that they have concerns about it. What we are in agreement with President Trump on is that we want to reverse the curse of the Biden years in taxation, regulatory, and government policies. So we want to work to pass my 21st Century Housing Act, which would lower home construction costs. We want to pass the Main Street Capital Access Act, which would lower compliance costs and refocus the bank regulators on safety and soundness, tailoring regulations to bank complexity. And when you think about the regional banks you just talked about and the community banks, particularly those banks under $10 billion, they make 60% of the 1 to 4 family home loans in this country. So we believe that with the tax benefits from the One Big Beautiful Bill, lowering compliance costs, focusing and tailoring regulations, and focusing on dropping the regulatory burdens and trying to build homes in this country, these are bullish signs for the GDP, for the nation. We don't want to do anything that throws off that gross domestic product. And one of the things I heard from colleagues is 2/3 of GDP in the U.S. is consumption. And so if credit availability is denied or reduced, that could impact growth for 2026.
Congressman, do you think the proposal as it stands could have a chilling effect on credit?
Well, I think this is what people that I've heard from in the House Republican conference have said to me is they think, gosh, this could mean that those Americans with lower credit scores have their credit curtailed in some way, even by a temporary proposal like this. And, you know, we've campaigned against government price controls in the 2024 election and Kamala Harris's efforts to put in nationwide rent control, for example.
Congressman, which is why it's so curious, the president is getting on the phone with the likes of Senator Elizabeth Warren and continuously has this text exchange we've learned through Axios with Zohran Mamdani. Do you think he is moving too far to the left and almost out of where your party is?
Well, I just think that Republicans want to work with President Trump to accomplish his goal, reverse the curse of the Biden policies and regulation, taxation, open up the economy besides our tax policy and the big, beautiful bill. I really believe that our Main Street Capital Access Act will make capital more available for small businesses all across the nation, produce economic growth, particularly in the home building area. Mike Flood's 21st Century Housing Bill that we put together lowers regulatory costs on building new homes, opens up things like the HOME program and the CDBG program to private sector partnerships to build more housing. We want more housing available. We want better prices, and that's the tack that we're taking. I think these are the priorities of the president.
Congressman, as the chair of the Financial Services Committee, have you spoken to Chair Jay Powell since the subpoena was delivered to him from the DOJ?
I have. Chairman Powell called and told me that this process was taking place.
And does he have plans to come to the Hill to testify?
Well, we've invited the chairman to testify for his semi-annual Humphrey Hawkins testimony, and we're working out the date now. We'll do that typically in coordination both with the Fed and with the Senate Banking Committee so that we can get the Fed chairman up for his semi-annual testimony on the Hill.
Congressman, do you agree with the efforts put forward by Senator Tillis talking about potentially stymieing any of the candidates that President Trump is putting forward or will put forward for the Federal Reserve until this subpoena is removed or this issue is resolved?
Well, you know, my attitude about this is really simple, which is Fed independence doesn't mean the Fed's immune from criticism or governors at the Fed are immune from criticism. And if people have questions and concerns about the construction project down there, about how expensive it is to build something in Washington, D.C., how expensive it is to build something after a 40-year high in inflation from the Fed and fiscal policy mistakes made at the end of the pandemic, those are legitimate questions. But to try to criminalize it and threaten people with a grand jury over disputes about that construction, I don't agree with that. And I think the Congress can do oversight about the construction project. And I think, as I said in my statement, I think this is a distraction from our partnership with President Trump in lowering cost of living for our citizens through increasing access to capital, lowering the cost of building a home in this country, getting the economy growing, along with all the improvements, the tremendous improvements we've had for working families that we passed in the One Big Beautiful Bill last year.
Do you think that it's actually illegitimate, this particular subpoena?
Well, I don't know that it's illegitimate because I'm not at the Justice Department and I'm not the U.S. Attorney for the District of Columbia. I'd say it is, in my personal opinion, an overreaction to concerns about the construction at the Fed, and I don't agree with that approach.
You've been friends with him for decades. Do you think he added to this distraction by coming out with a rare video as the markets were opening up in Asia instead of just replying to the subpoena?
Yeah, I think we'll always second guess whenever we make a public statement as a public figure. I won't second guess the decision that he took about that. I'll just let it play out the way it is. But I do believe that trying to criminalize that kind of behavior, I just don't agree with that.
How delayed do you think this could make going through the process of the next Fed chair?
Well, I think it could throw it off track. I think it's a distraction to Treasury Secretary Bessent's very able partnership with the president to identify a new Fed chair, something they've worked on for months. And the president has had interviews consistently over the last few weeks, and he's close to taking a decision. And that this decision, whoever made the recommendation to do this, I think was a mistake, because I think, as I've said, it distracts from our economic agenda, benefiting working families with lower cost and more accessibility to capital and housing. And it's a distraction to Treasury Secretary Bessent and President Trump's excellent work to identify a new leader for the Federal Reserve, something that we want, and we want clarity on Capitol Hill. So that's why I think whoever made a recommendation like this was not wise.
It hasn't been a distraction for markets, though. They pretty much shrugged it off. Do you think the markets don't view this as real threat to independence?
That's possible. I don't know that it's a threat to independence. I think it's a distraction to the work we're trying to do here to move the economy forward, to complement the big tax changes we made to benefit working families last year. We want to do the same thing this year to open up regulatory policy, make it easy not only just to permit the growth of the energy industry in the country and critical minerals, these are goals of the president, but we also want to reduce that regulatory burden on housing construction and capital access for the American economy. And if we don't have a nominated and confirmed Federal Reserve chair, that's a distraction to getting that done in the right way. And I think it throws the president's mission off track. That's why I called it a distraction, and I'm sticking with it.
Congressman, always appreciate your time, sir, and thank you for the congratulations. I promise you this, I'll introduce the little guy to SEC football later this year. I can't make a promise that he's going to be a Razorback fan, though, okay? It's got to be a winning team, French.
This is something we've got to talk about.
We'll try and work it out. Congressman, thank you. Congressman French Hill with the latest. I think pretty clear on where he stands on the issues around the Federal Reserve.
I thought you were going to say Baby Ferro was going to get introduced to the SEC and the regulations around the SEC.
No,
I didn't realize that you were going to go to that.
But SEC football.
Yeah, but it's clear where he stands. He basically is saying, look, it seems like this is an overreaction, it's a distraction, and he wants to focus on some of the gains they have made. And I guess that the key question is, how do you do that when people are not feeling it yet, at least according to a lot of the polling?
And he's working right now with the Fed, he said, to bring Powell up to the Hill for this testimony. I didn't realize his team was not a winning team. That's sad.
No, not great. Not great. Things can change, though. You're feeling sorry for him.
Come on, French Hill.
That's sad. The way you've said that, so much pity.
Well, you need bragging rights in Washington about something.
Of course you do.
So be a Mets fan.
Yeah, sure. How's that going?
Really, really well. I'm glad
right.
it's not baseball season.
Let's get you some data. Up next, we'll catch up with Neela Richardson of ADP. The opening bound is about 60 minutes away. Futures doing okay, higher by 0.4%. That's on the S&P 500. Check out the Nasdaq up by 0.9. Check this out in the pre-market. So tech story's good today thanks to the outlook from Taiwan Semiconductors. Got it, right? TSMC, brilliant. Check out the banks. Morgan Stanley coming out with some fantastic numbers. And the stock is now down by 0.8%. Goldman's down by 2%. And we saw this from bank after bank after bank over the previous 2 days.
And honestly, give me a reason. I mean, you could pick one, but it's nitpicking because ultimately the actual numbers are tremendous. I mean, when you take a look at the record highs in Goldman Sachs, at the record gains that you've seen in Morgan Stanley, and you look at the dividend increase for Goldman Sachs, the only thing you can really point to is a 54% gain in Goldman Sachs shares over the past year and a 38% gain in Morgan Stanley shares over the past year. And people saying, maybe we've gone a little bit too far. And that might be what we're seeing this morning.
Want to watch into the opening bell about 60 minutes away. Got to look for the data as well. Just kind of dripping out at the moment. Mike McKee's got an early look at some of the numbers. Good morning, Mike.
Good morning, John. We are waiting for jobless claims to drop. It would be the first week outside of the holiday period, so maybe give us a little bit better read on where we are. But in the meantime, the Philadelphia Fed has come out with their index. It's 12.6 from a negative 8.8, so an improvement there. We're also seeing an improvement in the Empire Index for New York, 7.7 from negative 3.7. And also, I was looking at the details of the Empire Index. Pretty much everything up across the board except for employment. Now, speaking of employment, a big drop again in jobless claims, 198,000 Last week's 208 has been revised down by 1,000 to 207,000. So drop below 200,000 now. Could still be holiday related, but this is definitely not in the weeks when the holidays were handled. The 4-week the continuing claims rather 1,884,000 down from 1,903,000, and then import prices are up just 0.1%. So it doesn't look like we're seeing a big increase in countries raising prices on what they're exporting to the United States because of tariffs.
Mike, 198. I mean, you've covered this for a long, long time. How low is that number? 198,000?
Well, it's a very, very low number. It's certainly not the record in recent months or years. But what we're seeing is certainly a growing labor force. There are a lot more Americans out there, so there are more Americans working. So the number of jobless claims falling just tells you that the labor market is holding in there. We're not seeing people losing jobs, and the number gets more impressive in terms of a percentage of labor force as it continues to go down.
It's incredibly impressive. Mike, thank you, sir. Mike McKee with the latest. An impressive jobless claims number of just 198,000.
As you would say, as a sage I once knew said, it's the right kind of downside surprise. And what you're seeing right now is a market response that really does highlight how much the Fed's going to look at this. And anyone who's anything close to resembling a hawk is going to get some sort of sense that maybe they don't have to cut rates so quickly. And you're seeing 2-year yields rise to the highest levels, some of the highest levels we've seen since the end of last year. I mean, it just raises this question, where is the urgency here? Is this a deteriorating labor market, or based on the economic indicators from Philadelphia and New York paired with this jobless claims number, are we looking at an economy that's actually firming up and a labor market that actually could be improving, not deteriorating?
If I came back from a year off, never mind a month, and you showed me one data point and it was jobless claims, and I looked at that, I'd be like, everything's okay, there's nothing wrong here. Labour market's rock solid. That's very, very impressive. And to your point, yields up at the front end, up by 3 basis points on a 2-year, on 10s up by 2. Still very, very range bound on a 10-year maturity. That yield at the moment about 4.15, 4.16. Neela Richardson of ADP needs to explain what's going on here. Neela, good morning. Good to see you.
Good morning.
How do you explain how we're sitting here worried about a labour market? The Fed's just cut rates by, 75 basis points over the period of 6 months or so, and yet we've got jobless claims at 198.
Well, I wrote on Tuesday that the labor market is tighter than we think, and that's how you explain it. What we're seeing is that it's a labor market where there's, as been said before, little hiring, little layoffs, but also pay growth has been robust throughout 2025. And let me tell you what that means. Let me unpack that, because we spend a lot of attention on the monthly jobs numbers. We need to spend more attention on the wage numbers, because they tell the complete story. And that story is that workers are largely staying put. They have very little desire to rush out and quit their jobs, but employers are having to pay them more to stay in place. So when you look at the wage premium between a job stayer and a job changer, it is very low. We calculate it, we clock that at less than 3% going back over the course of the year. But the pay levels, the growth levels are high. 4.4% for job stayers, 6.6% for job changers who are sensitive to this labor market. It's taking more pay growth to keep a worker, and that's adding to costs.
Now, typically that's what you see in an expanded economy. Typically it's what you see in a very tight labour market. I still don't understand why the Fed's cutting in that kind of environment. What's gone wrong here? What's happened?
The theme of 2026 is perception versus reality.
Explain.
When I look across the board at all the economic indicators, they are so strong. I mean, wage growth is strong. You look at GDP growth is strong. Retail sales is strong. The only thing that seems weak to me, other than these pretty modest job gains, is consumer sentiment. Why is sentiment so sour when everything it looks so great? Even our infrastructure graders, the civil engineers recently put out a report that America's infrastructure is getting a solid C. Engineers are the hardest graders in the world. Everyone knows that. My son is finding it out this year. But they're still grading at higher grade levels than they have historically. So America looks strong, but sentiment looks bad. And there's a reason for that. perception is different than reality.
Well, how much is this also that we're talking about averages and not necessarily the different tiers of earners? And it could be that, say, the top tiers of earners are doing really well, are seeing their productivity increase, and are seeing their their wages, their take-home pay, increase substantially, and the people at the lower end who are employed in low-wage work are not seeing those increases and are seeing the inflation that are coming on the heels of what's happening at the top tier.
Lisa, you just hit the point, right? Underscoring that perception versus reality. Another way to say that is micro versus macro. And when you look at the granularity of job changers, what you're seeing is it is not equal. Where we're seeing the highest paid growth is not where we're seeing the most job growth. And that is key. You're seeing high pay growth in trades like construction, tied to data centers, for example. But you're not seeing a lot of job growth there. And there are demographic and structural reasons to that. And even if you unpack this wage distribution over time, what you're seeing is that low-income workers are not keeping pace with inflation. And that is very different than 3 years ago when they were outpacing in terms of income gains. So yes, there is a lot of action going on underneath the surface of the macro indicators that point to a widening of the top earners and the bottom.
And it just adding to this sentiment that is very reality-based, which is that people who are making a lot of money are also seeing the use case for their jobs go down. I'm looking at some of the earnings that we saw, Bank of America coming out saying that they're going to let their headcount shrink as they deploy more artificial intelligence. Citigroup saying that they are going to, over the time, use automation and expect automation and AI to potentially reduce some of the headcount and also just increase efficiency. I mean, how much is that also hanging over sentiment in a way that these numbers don't pick up?
Right. So that's a structural change that no one saw coming. Maybe 4 years ago, I shouldn't say no one, but very few workers saw coming. And it's now part of the conversation. It's part of the hiring strategy in a way that it hasn't been before. And it's hitting professional white-collar jobs, which you thought would be immune to this kind of stuff, immune to this kind of automation consideration. But AI has changed all that. And so I do think that harkens back to the sentiment and to the company long-term strategy. But this is a transition. That's not the end of the story. I think that this will be a short-lived transition because the productivity around AI is so vast that it's yet to hit the worker.
How does the Fed think of this moment? So challenging.
I think what they're very focused on is the data point that drives a decision. This is a data-driven Fed. But the problem is the data doesn't stack up to the decision in the way that it has been in the past. The data is pointing to a pretty strong economy. The data is pointing to a pretty low unemployment rate. And the data is pointing to a structural, not cyclical change in monthly job gains. And so it does put them on the back foot when you're trying to interpret data and use that data to make a decision.
Nita, a labour market clinic. It's good to see you. Thanks for being here. Nita Richardson there of ADP off the back of a very low jobless claims print. Mike McKee has more on that number and others. He's back with us for more. Hey, Mike.
Hi, John. One thing we want to point out here is that some of this is a seasonal adjustment factor. The unadjusted number of claims total 330,684. That's an increase of 32,000. But the seasonals expected a bigger increase and so have pushed down somewhat on the seasonally adjusted number. And this is what I find interesting is that last year at this time, there were 352,357 jobless claims, which is about 30,000 more than we saw this year. So we are seeing a drop in even the unadjusted numbers on a year-over-year basis in terms of comparison. And the one other note is that in terms of the import prices, there's almost no data because of the government shutdown. We saw petroleum prices drop 1.3%, food and beverage prices down 0.7, and that's it. That's all that's out there. So you can't really put much stock in what we're getting in terms of import prices. No data also for October. So October, November import prices, we'll have to wait till those get updated down the line.
Incredible. We're still recovering from that. Mike, thank you, sir. Appreciate the additional clarity. The Fed's Austin Goolsbee of Chicago, speaking to the press here in America just moments ago, still seeing strength in the US economy, which kind of echoes what Nita explained what she's seeing in the labour market.
Which is the reason why, even though Fed Chair Jay Powell has sounded a little bit more dovish, some of the members sound a lot more hawkish than he does when you actually hear from each one of them. They are concerned still about inflation being above target for, what was that, 57 months? Is that what Jason Thomas said? 57 months, I believe.
It's been a long time.
Oh, my goodness.
Right, never mind changing the target and, you know.
I mean, come on. It's been changed.
It's 3.
Yeah. Exactly. Look at it.
They've accepted it.
I think so. I think we've gotten to that place.
Let's give you an update on stories elsewhere. Your news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Recapping the data we just got then. U.S. jobless claims falling last week to 198,000. That's below expectations for 215,000 and marks an overall increase of 7,000 from the prior week. Continuing claims came in at about 1.88 million. That was obviously just under the estimate for 1.9 million. Oracle is hiring for more roles in Nashville than any other U.S. city. The company currently has fewer than 1,000 workers assigned to offices in the southern city, but aims to create more than 8,000 jobs there by 2031. Oracle is also planning a massive campus in Nashville as it works to center the city around its future. President Trump posting on Truth Social he'll impose the Insurrection Act in Minnesota if lawmakers are not able to quell protests in the state. Last night in Minneapolis, a demonstrator was shot by an ICE agent. The Department of Homeland Security says the victim tried to flee a targeted traffic stop and attacked an officer. That is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. Up next on the programme, the Continental Resources Chairman, Harold Hamm, as the US has begun selling Venezuelan crude. Plus, Vonnie will be back with your morning movers. Morgan Stanley, Goldman Sachs in focus. Both of those names, despite some very good numbers, trading lower this morning.
In the market itself, it's not simply sell America, buy the rest of the world. There's also a lot in the U.S. that looks cheap. I think just generally this very positive market backdrop, the degree of optimism that you see in virtually every strategist report is something that actually suggests there's a lot of room to run in value and cyclicals going forward.
Brilliant to catch up with Jason Thomas of Carlisle a little bit earlier on this morning on a better outlook for the US economy and US markets. A consensus view, I know. Equity futures on the S&P 500 positive by 0.5%, on the Nasdaq 100 up by 1 full percentage point. TSMC and a strong outlook from Taiwan lifting tech stocks this morning, but the financials. Let's have a look at the banks. Your morning movers with Vonnie Quinn. Hey, Vonnie.
Hey, John. Yep, record revenue in Q4 for Goldman Sachs, and in fact, records all around the block for both of these universal banks. But, you know, in various different areas. So for Goldman, let's start with Goldman. You saw net income hit a record. Equities trading revenue in the quarter didn't just hit a record for Goldman, it hit an all-time Wall Street record. So Goldman really won on the equities trading side. Investment banking was up 25% as well at Goldman. However, operating costs there hit 18% year over year of growth, and perhaps that is something that traders are not enjoying, or also perhaps it's the huge run-up that we've seen in Goldman's shares over the last 12 months. Morgan Stanley is flat right now, as you can tell. Another great quarter from Morgan. For them, it was more the debt underwriting. It was up 93% year over year now. As you know, debt was on fire, the AI deals across the street, and Morgan was involved in many of those. But that meant that investment banking fees from Morgan were up 47% year over year. So that far outstripped the 25% gain of Goldman. It was a year of net record income from Morgan Stanley. So as you can see, lower slightly in the pre-market, but just by a very small fraction. All right, let's move on. We have TSMC up 5.5%. So there we had an outlook that really just blew away estimates as well. A revenue of 30% growth there. And also for TSMC saying that, you know, they're going to be spending as much as $56 billion this year. So a huge outspend on the capex in comparison to what analysts had been expecting. Now, when asked if AI demand was real, the CEO, C.C. Wei, said, look, he's asking himself that question as well, but they are going to be very careful. Last stock we're watching today is Spotify. It's been under a little bit of pressure, though it still is up 8% year over year, up 1% of the pre-market. It's coming up with an answer to increase the subscription price by $1 to $12.99 a month starting next month from $11.99. Apparently people are getting a little bit sick of the algorithm that keeps presenting with them with their music that apparently is from their taste 3 years ago. And also, of course, YouTube is coming for their lunch as well.
There we go with the update. Vonnie, thank you. Appreciate it. Some of the movers to look for going into the opening bell. Elsewhere, the US is officially selling Venezuelan crude. Multiple outlets reporting the Trump administration has completed its first sale ahead of a meeting with the Venezuelan opposition leader later on today. Harold Hamm, the founder and chairman of Continental Resources, the largest privately held oil and natural gas producer in the world, joins us now. I should add, Harold, American energy legend, pioneer of fracking. Going to make you sound like a sports star. It's good to see you, sir. I know you had a meeting with the president just last week alongside other energy executives. Can you give us your impression of what things sounded like and the opportunities available in a place like Venezuela?
Well, certainly there's a lot of resource in Venezuela, and as everyone knows, and so it's a much safer place today as a result of the president's actions. Trust the president, and taking out this narco terrorist. It's a great move in this Western Hemisphere. And good things will come from it. We're already seeing some of those develop. And yes, it was a very interesting meeting as a lot of oil company executives look at the possibilities in Venezuela and assess those.
Harold, are you looking at the possibilities? How interested are you in bringing Continental to Venezuela?
You know, as told the president, Continental has a policy of first of all, looking at these market entries into wherever we go. It doesn't matter if it's Turkey or Argentina that we've been public with our entry there. But looking first at the credibility, the geopolitics, looking at the stability of the country and what the future looks like. And so we've certainly done that and doing that here. But first of all, look at the rock quality and whether it's worth going there, period, from a resource standpoint. And Venezuela meets that criteria. But, look at the overall geopolitical situation, what that's going to look like in the future. So that's what I've, related to the president. And I think a lot of other executives did the same thing.
Harold, what about looking at the price of oil and where it sits right now? What oil price do you need to see in order to, say, have this adventure in Venezuela than just drilling more in the United States?
Well, we say that the best cure for low prices, is low prices. It cures it and brings the price back to where it's sustainable in the future. And certainly you can't produce crude below the cost of production, and we know that. And certainly it's very cheap. And we think some things ought to be done in the U.S., like refilling the SPR, for instance. While crude is so cheap, we ought to be doing that. China's doing that. They're ramping up their storage to 2 billion barrels, and the U.S. should be doing things like that. While we're in this cheap market.
Do you have an outlook on where prices are going, given the fact that we do see we're going to be in a glut? There are these reserves in Venezuela, but at the same time, there's geopolitical concerns in the Middle East.
There's a lot of geopolitical risk in Venezuela. Certainly, we've seen companies. Darren Woods said Exxon had been there twice and been nationalized. You don't want to go there and spend a lot of money and see your assets go away when nationalization occurs. So, there's got to be guarantees against that. We've seen other companies burned real bad there. So those things certainly resonate. And, you take that in consideration before you enter a country.
Are you concerned that the development of Venezuela, that the focus by the U.S. on more supply from OPEC will hurt the U.S. shale industry significantly over a longer period of time?
I think it could, but I think it's going to be so slow in development. It's going to take a long time. This is rough material that comes out of there. It's basically bitumen, tar, 9-degree gravity crude. It takes a lot of upgrading to get it to where you can market it. In fact, even move it. It requires diluent, condensate mixed with it to move it. So there's a lot of challenges, a lot of resource, but a lot of challenges. So it's not going to come on very quickly. So I think as far as the risk to American crude, there's a lot of risk in the world, but I would say that's a lower risk than a lot of people are imagining.
Harold, can you talk us through the lifespan of shale in America? Do we need to think beyond shale in America?
Okay, Jonathan, if you don't mind repeating that, I didn't quite.
No problem, Harold. Can you talk us through the lifespan of shale and whether we need to think about life beyond shale in the future?
Okay, I'll talk about the storage and what's happened, with SPR. I think that's your question. I didn't have a little technical problem here, but it was basically SPR was drained by the former Biden administration and took it down to about half full where it's at. So, we've got storage capacity there of over 700 million barrels, 740 or something like that. It's about half full now. So if we put 1 million barrels a day, it'd take over a year to replenish it. So it takes probably a year and a half. But it ought to be done, at these prices, certainly. We ought to refill that strategic storage facility in the U.S.
Howard, appreciate your time and our apologies for the technical connection. It's on our end, I believe. We're going to leave it there. Thank you very much, sir. Harold Hamm, the Continental Resources Chairman, legend of American Energy. Coming up tomorrow, Eric Friedman of Northern Trust, Erica Najarian of UBS, Stephen Parker of JP Morgan, Mona Mahajan of Edward Jones. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.